Tom Keen's Secrets, keeping you up to date with news from around the world with the first word. I'm Lisa Mateo. Federal Reserve Chair Jerome Powell hinted the U.S. Central Bank's latest 25 basis points interest rate increase could be the last, suggesting that officials may pause their tightening in June. But Powell pushed back against any expectations that the Fed will be cutting rates by the end of the year. A new poll says almost half of adults in the U.S. worry that their bank deposits aren't safe. That's a level of concern as high or higher than during the 2008 financial crisis. The Gallup poll was conducted last month following the failures of Silicon Valley Bank and Signature Bank. TD Bank and First Horizon have agreed to terminate their $13.4 billion merger agreement. In a statement, the two banks said there was uncertainty if and when regulatory approvals could be obtained. As part of the termination agreement, TD Bank will pay First Horizon $200 million. Shares of First Horizon plunged more than 40%. In a rebuke to the President Biden, the U.S. Senate has voted to reinstate tariffs as high as 254% on solar panels from Southeast Asia. The bill now heads to the president, who has promised to veto it. All this underscores a deep clash over continued U.S. reliance on foreign imports to drive renewable energy development. BMW posted first quarter earnings that were better than expected, thanks to strong sales of its most expensive cars. But the German luxury automaker left its outlook for the full year unchanged. Softening demand around the world is threatening sales. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
In Big Ideas, we show the productivity increases that are possible because of artificial intelligence. It's these companies who could be some of the biggest beneficiaries if they harness AI correctly. I think a lot of people are looking for the killer app, like they look like these viral apps that the internet delivered. The killer app for artificial intelligence is productivity gains, and any company does not harness it is probably not going to be one of the big winners out there. And just one other thing on AI. The real winners here are going to be those companies that have proprietary data and have lots of it, have the best domain expertise, best AI expertise, the best pools of high quality data to basically create new businesses.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
A record year of growth, hand over fist all year.
We're just getting started.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, today on Bloomberg.
I think the Fed broadly missed the fact that this interest rate risk that they had created by being very late to tighten monetary policy, that they created by flooding the bank with deposits by doing quantitative easing, that they created part of the stress on the banking system that arose when they had to tighten monetary policy by 5% in a little over a year. So the Federal Reserve has some culpability here.
That's something only an ex-Fed official can say, because the current Fed officials don't want to go there. That was Bill Dudley, the former New York Fed president and Bloomberg opinion columnist, laying some of the blame at the feet of this Federal Reserve for hiking rates so quickly from 0 to 5 in a little more than 12 months. From New York City this morning, welcome to the program. Let's give you a snapshot of things right now in the equity market. On the S&P 500, we are negative by 0.25%. Let's pick out a single name. I think you know where we're going. PacWest in the pre-market, we're negative 47%. Yesterday evening, our colleague, Matthew Monks, pointing out, according to people familiar with the matter, that the bank was weighing a range of strategic options, including a sale. The company itself saying in a statement which came through overnight into this morning that the company's been approached by several potential partners and investors. Discussions are ongoing. The company will continue to evaluate all options, Tom, to maximize shareholder value.
What I would note is we've just now made a new low in the bid. What's very important, for those on radio, we're looking at $3.37, and basically over the last 40 minutes, we haven't been able to catch a bid. And I think it's important. What I would suggest, John, and maybe it's just anecdotal or maybe a quick study of history, is you go on from 1 failure, 2 failures, 3 failures, et cetera. The urgency by executives to get this fixed fast is dramatically heightened. I can't imagine what the good people on Rodeo Drive are doing in Beverly Hills this morning.
The stock is moving very quickly. Apparently, according to the company, deposits aren't. It's a key point. And this comes from PacWest as well. And I think we need to read out this line that comes in the statement, that they've not experienced out-of-the-ordinary deposit flows since the sale of First Republic Bank and other news. They go on to say that core customer deposits, Tom, have actually increased since the end of the first quarter.
Yes. Okay, they've increased, but from 19, let's review it again as we did last hour, from 35 billion or 34 billion, whatever, who's counting, down to 28 billion, John, is fine. But in that period, they did lots of loans, lots of real estate, lots of this, lots of that. And as Mr. Powell has moved rates up, bond prices, Lisa, help me here with my hands, bond prices are coming down, real estate mortgage value is coming down. And so as your deposits are stable, that's great. But on the other side of the ledger, what's happening? And the answer is weakness.
It's a really good point, Tom. It's a really good point. There's a lot of things going on here that are contributing to a lot of nervousness around these names. And Tom, to your point, sometimes this becomes somewhat self-fulfilling. You start to see these moves and they feed on themselves.
They feed on themselves, and the CEOs begin to act differently as well. Can we do something constructive and talk about something optimistic?
Apple?
I mean, you know, let's do that. Let's switch to Apple here. 28% per year return over the last 10 years is different than the banks. Thomas Forte knows this. He's senior research analyst. D.A. Davidson's on this afternoon's festivities. Tom, I know there's lots of strategic ideas out there as well. I went back on the Bloomberg. Folks, the FA screen on the Bloomberg is just absolutely stunning. And the shares taken in, they're Intel-like, except Apple was minting money unlike 15 years ago when Intel wasn't. And the share buybacks over the last number of years have been absolutely extraordinary. Are they going to drop a bombshell today on use of cash, on dividend, and further new share buybacks?
I think it's going to be a reminder that Apple generates a ton of free cash flow. And if you're not going to buy the stock and Warren Buffett's not going to buy the stock, Apple's going to buy the stock. So I expect another increase in their share repurchase plan. When you couple that with their dividend, though the dividend yield is still quite modest, they're returning a lot of that free cash flow they generate back to shareholders. And I think that's contributing to the strong performance for the stock.
What's your glide path on revenue? I know they had a couple years ago a big pandemic boom. Everybody had to buy a computer at home. Maybe they were giving them out at First Republic Bank. But what is the single-digit revenue glide path of Apple forward?
So if you think about Apple on a near-term basis, they should benefit from the reopening of China, the end of the Chinese government COVID zero policy, to the extent that 10% of their sales are to Chinese consumers. They have seen some softness in some of their economically sensitive revenue, including advertising. Think of it as advertising for app downloads, especially in mobile gaming. But there's reason to expect that as the economy improves and on the continued strength of the iPhone, on the 5G network upgrade, that Apple may be able to sustain double-digit top-line growth. The good news is that there's easing of a very significant headwind in FX, to the extent that the dollar weakened materially versus the pound, the euro, and the Japanese yen in the March quarter versus the December quarter. So there's reason to be optimistic that revenue growth can improve going from here.
Tom, we've written some stories that talk about the stealth move away from China, away from production in China, and away from just in general, how big the Apple footprint is there. Are you expecting to hear anything about costs incurred on that transition away from the second largest economy in the world?
The answer is yes. And Tim Cook is an amazing CEO. I refer to him as CEO by day and diplomat by night. But he has a challenge here to the extent that he has to broaden his supply chain and move out of China to some degree. The good news is that as he expands into India, he kind of has the footprint of what he did in China, or sorry, the game plan of what he did in China and mirror that for India. But yes, I think they have to more than stealthily diversify their supply chain so they're less dependent on China. And I think that's going to be a challenge.
Especially at a time when companies seem to be rewarded for saying ChatGPT or artificial intelligence, and it's very difficult to talk about these highfalutin ideas when it's just nuts and bolts moving things around the world and trying to put things together. Is there anything in the latest hot trend that Apple can hang on to for future growth, or are they kind of tied to an old economy kind of reality that's very much tied in the physical world?
Yeah, so Tim Cook last quarter talked about AI as being a horizontal technology, not a vertical one. So when you think about Apple and AI, they're using AI on many levels. I think of Siri as an example. And I think that what you're going to see is that I'm of the belief that longer term, they could totally create a car versus just having kind of the consumer-facing operating system in the car with CarPlay. That would be leveraging a lot of artificial intelligence. Depending on your view of, the metaverse and augmented reality and virtual reality, there's opportunities there as well. I think Apple is quietly using artificial intelligence on many levels. Microsoft's better at PR. Apple, I would argue, is better at technology.
Tom, that comment at the end there, that is not the first time I've heard that. Are you suggesting, pretty obviously, that you think that the company that we're all looking at for some kind of AI revolution is just the one that's doing a better PR job right now?
I absolutely feel that way, although it is hard to debate who's better at PR, Apple versus anybody. I mean, Apple's amazing at PR. Yeah. But yes, I'm of the belief that when it comes to AI, when you compare Microsoft and Apple and Google, Microsoft's doing the best job in PR.
I didn't think we were going to have this conversation. That's brilliant, John. Thanks for bringing that up. Tom Forte, what's the glide path on the chip? I always go back to the A series of chips. Is there room for improvement to ever more amaze us with their chip development over the next 2 or 3 iterations?
The answer is yes. The beauty of Apple is the next device is always the fastest and the best. And I think that when you saw them take some of their chip production and chip design in-house, that enabled them, again, going back to PR, to promote how this product's better and to get us to upgrade. So yes, I think the glide path is a good one there.
Hey, Tom, great to catch up. Thank you, sir. Tom Forte there of D.A. Davidson going into Apple earnings after the bell a little bit later. I heard those precise words from an analyst last week about Google. Don't write Google off. And they were essentially saying that they think that Microsoft is just doing a better PR job right now than Google is when it comes to artificial intelligence.
Why are you laughing at me? That was so snarky. If I'd said that, I'd be in the surveillance timeout chair. You say it's charming.
Well, he basically said it, and we've heard it from a few people now, Bramo, with regards to Microsoft.
I mean, who's Binging, right? I mean, that's ultimately what it comes down to.
Who actually goes on Bing? I still don't know anyone that goes on Bing.
It's the actual default search engine that comes up on certain laptops. So that's the reason why Bing has as much traffic.
And then you download Chrome. I thought that was the thing.
That's exactly what people do. Well, here's the question. Can they make Bing better than Chrome? Can they make it better than Google? And a lot of people saying,
This is like with Donna Regrana looking at cloud. Where's the cloud in 5 years? Where's the cloud in 10 years? And with Apple, it's a chip, the A15 chip. Is there an A16 chip? Is there an A20 chip? And does the chips just continue to iterate? I mean, why do I like this toy? The battery lasts longer than the last time. It's that stupid.
Until it gets old and they slow it all down and
they
burn
purposely
out your
do
battery.
that.
We're going to start that again.
That's what it feels like. No, it's a thing.
This is known.
It's a thing.
They
it's
do.
known.
It's not
This
just
is
the bat.
known.
Yeah.
It's a thing. Wayley at BlackRock coming up next. We won't talk about that. Equities down by 0.3% on the S&P 500. No one around this table slept. It's probably going to get dangerous as the show progresses. This is Bloomberg.
Our studios in New York and San Francisco. Our expert hosts of the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
Manchester, not London, is the best place to find a new job in the UK. That's the surprising finding of data analysed by Bloomberg from Reed Recruitment. While you might think that London is the biggest pool of jobs, which it is, Manchester is leading the way when you look at the number of jobs per local worker. Thousands of voters in the so-called red wall seats flipped Conservative in the last election, hoping that the Conservative government would be able to bring more wealth and prosperity to their area. However, the data still show a country where employment prospects are thin on the ground in large pockets of the northeast, northwest, and areas all around the coast. Aside from Manchester, the only areas that are really leading the way are Cambridge, Reading, and Milton Keynes, indicating the good news for the rest of the UK might stop there. With Prime Minister Rishi Sunak facing the prospect of a general election as soon as next year, the pressure's now on for him to find ways to spread wealth outside of London to some of those more neglected areas. In Chancellor Jeremy Hunt's budget, he unveiled plans for 12 new low-tax investment zones around the UK and £760 million of spending on infrastructure and regeneration. Manchester's one of the oldest devolved areas in England, and there are signs that that's really beginning to pay off. What's on Jeremy Hunt's plate now is whether he can spread that success to other regions.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
But are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
We've got inflation that looks like at best it's moving sideways, and that's not enough for the Federal Reserve.
We don't know entirely that we're done. We can't fully rule out action in June at this point.
They definitely want to have the option not to hike at the June meeting.
The statement all but basically admits to this is a pause.
The risks are that now financial conditions in the regional banks, of course, will tighten.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City this morning. Good morning, good morning. This is Bloomberg Surveillance alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Let's get straight to this market where we're negative 0.3% on the S&P 500. Looking at PacWest, negative 45% and getting absolutely hammered. Some reporting by our colleague yesterday evening, Matthew Monks, pointing out that PacWest has been weighing a range of strategic options. Had the statement from the company overnight into this morning. PacWest pointing out that the company has been approached by several potential partners, investors. Discussions are ongoing. The company will continue to evaluate all options to maximize shareholder value. They're very, very keen to point out what's happening with deposits, Tom. They say they have not experienced out of the ordinary deposit flows following the sale of First Republic Bank and other news.
Well, I'm looking at the banks here, and Pacific West has been completely pushed aside here by the bid on First Horizon in the last 10 minutes. FHN, John, these are all differing stories, aren't they? Matthew Monks writing up PacWest as you review. First Horizon is where TD of Toronto walks away. It's just all there is to it. But the outcome's all the same. And to me, the shift here occurring in the last 48 hours is from an interest rate analysis over to a credit analysis, which is why it's so important to go to Wei Li here in a moment.
The Federal Reserve says the U.S. banking system is sound and resilient in its latest statement. Chairman Powell was keen to signal just the same at the news conference yesterday, Lisa, but we've gone from bank to bank to bank to bank. And we're going from one bank to the next this week, too.
I love what the former Fed president of the Atlanta Federal Reserve Dennis Lockhart had to say in an interview on Bloomberg Television last night. He said, "I would like to believe that Jay Powell has information that suggests the situation is contained or containable. I would like to believe," not exactly a ringing endorsement, and that really is what this is, because we don't have a sense of what they know, especially given some of the distress that's been baked in some of the share prices.
You brought up a former Fed official, so let's throw in another one. We heard from Kaplan a little bit earlier this week, and I think, Tom, he really started the conversation that you're building on. This was the rate shock that we're discussing right now. The next phase potentially is a credit shock, and we still haven't really got our hands around what that might look like.
And this is like Richard Fisher, even though he does have some economic cred. Kaplan and Fisher are more financial-based than economics-based, and I think that's a critical point here within what is a crisis. Moments ago, he joined us yesterday on set. Torsten Slok, was it the morning or the afternoon? I can't remember. Torsten Slok was sitting next to me with Apollo, and John, he goes to the heart of the matter and the credit dynamic wrapped into the recession. Small and medium-sized businesses linked to small banks like PacWest and First Horizon.
The good news, Tom, I can confirm he was next to you. You didn't imagine it. It was in the afternoon. It was when we were talking about the Federal Reserve, at least I think it was. In the equity market right now, we are negative 0.3% on the S&P 500. Yields are a little bit higher by a single basis point. Looking out for the ECB a little bit later, in about an hour and 12 minutes from now, we'll get a decision from them. Lisa, the euro going into all of that, unchanged at 110.64.
I'm shocked. This is my shocked face. Today, 8:15, we are getting that ECB rate decision. 8:45 is when Christine Lagarde takes the helm and explains why they are raising rates into potential weakness and what the threshold is for them to stop. Today, also, we were just speaking about artificial intelligence and ChatGPT. This is interesting. U.S. Vice President Kamala Harris is meeting with the CEOs of Microsoft, Alphabet, and OpenAI to talk about potential risks that could be emerging. And I do wonder whether there's a policy implication or whether this is just simply a PR move ahead of what clearly are some pretty major shifts. And we are getting a slew of earnings. We just got Shopify cutting jobs and talking about selling some of their businesses. This is really going to be an ongoing grind of names, but Apple front and center after the bell, given the fact that it is such a major component of the index and a major component of the gains year to date, with almost 30% year to date returns at a time when people had written off big tech.
And I got 3 sources, Lisa, saying that we should look for a share buyback announcement. Usually we don't see that during earnings. I mean, they do it afterwards or something. And I really wonder if you see a use of cash announcement here and then some form of new bond offering from Apple.
Well, you saw what Tom Forday said 10 minutes ago.
Yeah.
You heard what he said. If investors don't want the stock, Apple will buy it.
Yeah.
That's kind of like the cheat mode in the Apple stock, right, for the bulls. There's been a massive capital return program for a long time.
I went back and looked here back 15 years at Intel. Intel did this. They bought back all that stock, but Intel wasn't the profit machine Apple is. There's a big, big difference down at the bottom of the income statement.
Those numbers come after the close. Joining us around the table right now, Wei Li, Global Chief Investment Strategist at BlackRock. Wei Li, let's talk about what Tom's discussing and build on it. We've had the rate shock. Are you looking for some kind of credit shock to follow?
We are expecting a version of credit tightening and crunch to come through to do some of the output destruction work for the Fed, which is why we have now entered the beginning of the pause phase. They signaled pause yesterday. We're expecting we're getting close to peak, if not at peak. But more importantly, from the meeting yesterday is that they continue to consistently reiterate no cuts for this year, and markets are pricing in 3 cuts for this year, and that disconnect is going to be a source of further market volatility.
If I look at 3 months, 10 spread out to 193 basis points, I can state I've never seen it in a textbook. I've never thought about it. Back 30 years, it's a 3 standard deviation move. Totally unprecedented. In your note, you talk about short-term government paper. What will short-term government paper do when in some form the 3-month, 10-year differential cracks?
Well, we expect a short-term government paper to give you income, which we haven't had in fixed income for a very, very long time. And that is notwithstanding the debt ceiling uncertainty, and that is notwithstanding this dispersion, this huge kind of discrepancy in terms of yields that you get in 3 month versus 10-year. If you hold it out for maturity, some of that uncertainty also kind of washes away. The curve is extremely inverted. It's so inverted that we think the next move is for 10-year yields to come back up and curve to steepen from these extremely inverted levels, which is why we long the front end, but we are less constructive on the long end of the curve.
Wait, did Jay Powell give you confidence that they had under control a sense of how deep some of the banking fissures go?
Can he give anyone confidence at this juncture, seeing that it's still early days? One thing I would say, though, in terms of what's playing out in the banking sector, is that we don't think this is a banking-specific, systemic type of crisis. We think that this is just another expression of financial cracks appearing in response to the fastest rate hike cycle since the 80s. Arguably, what happened in the UK last September with the LDI gilt yield spike volatility episode was another expression of this financial cracks appearing. We know that as we fight inflation in a world shaped by supply, cost of fighting inflation is higher and cracks would appear and it would carry economic cost, and that's starting to come through.
What's the next progression in this cascade of cracks that you see? And is the only policy response that can really address this rate cuts?
Or provision of liquidity. They have been very swift with that to start with, but now the boundary is getting blurred a little bit through the transmission channel of credit tightening. So which is why we think that we're basically at a peak rate unless inflation surprises on the upside because of this huge uncertainty in terms of how big the credit crunch is likely going to be. And it's still early days to quantify precisely.
Can we turn to Tom's big focus at the moment? We thought we'd all be bailed out on the growth side by China's reopening. We've had a couple of signals, the manufacturing PMI in the last week, some company earnings indicate that maybe the reopening and this boom we might get this year is a little bit of a head fake. Where do you come down on that now?
Well, the Chinese restart, the reopening is likely going to be very domestic focused. You see consumers spending more and travels during the past bank holiday week has been very strong. So consumer is going to play a big role in this restart, which potentially limits the magnitude to which actually it can come to the rescue of developed market economy and the recession foretold. We're still of the view that Chinese growth can clock above 6% for this year, but we're also still of the view that in the US we're likely heading into recession second half of the year, especially as consumers starts to kind of run down on their savings buffer and their spending appetite is starting to stall.
You're one of the most important Chinese voices in the Western world right now with BlackRock, with your prodigious abilities in mathematics. And the zeitgeist I see among corporate officers is to expand off the Pacific Rim west in China, to not be in 2 cities or 3 cities, including Beijing, but to move into 5, 6, 7 cities. John mentioned LVMH the other day as an example of this. Do you perceive that there can be a 3-year, 5-year, 10-year expansion by Western companies into other China cities, or are we always wedded to Hong Kong, Shanghai, and Beijing?
I think when it comes to managing geopolitical risk and diversifying geopolitical risks, I think it's really important to recognize that the world today is more intertwined. It's more intertwined and the trade linkages are stronger as well. So no longer can we just fade geopolitical risk premium. We have to kind of think about persistent risk premium as we construct portfolios. And when it comes to China risks and spreading that out, both for investors and corporations, I think that is a certain direction of travel, certainly.
Weili, this was wonderful. It's good to see you. It always is here in New York City. Weili of BlackRock, thank you very much. BlackRock at the moment and Weili's team underweight, mostly underweight equity markets at the moment. The broader equity market, negative 0.4% on the S&P 500. Right now, looking at PacWest, just to keep on top of that for you, we are negative 45%, Tom, in the pre-market. That's the name to watch this morning for a lot of people.
A little bit of bounce. We're not getting it with First Horizon, the shock off TD right there. We're still looking really right down in the bid with First Horizon, Serena, I'm going to steal that from Whaley, that phrase, directional travel.
Yeah.
That's the mystery of the Pacific Rim, is the ability to invest and get away from the stereotypes of 10 and 20 years ago. Can we expand out in a business enterprise? Like Apple's looking at India is just one example.
Well, for the growth path, it's the what next of it after 2023.
Exactly, the marginal, yeah.
We're looking for that reopening pop, and then, Lisa, it's the what next? Down to what?
Yeah, and this is really, honestly, we aren't sure, but most people think significantly lower than where we've been.
Equities right now, negative 0.4%. In the next hour, a decision from the ECB. Is it 25 or 50? Chris Turner of ING joining us shortly.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Federal Reserve Chair Jerome Powell has opened the door to a June pause for interest rate hikes. And policymakers raised rates for the 10th time since early last year. And Powell hinted that might be the last one. But he did stop short of declaring victory in the fight against inflation. Meanwhile, the European Central Bank is poised to slow the pace of interest rate increases today. That's after its preferred measure of inflation eased for the first time in 10 months. Officials at the central bank are expected to raise a deposit rate by a quarter point to 3.25%. Bloomberg's learned the European Union is discussing a new sanctions mechanism. It would target third countries that it believes aren't doing enough to prevent Russia from evading sanctions. The process would focus on those that can't explain spikes in trades of key products or technologies. Funds managed by Apollo Global Management affiliates have agreed to buy Arconic. Now, the all-cash transaction has an equity value of about $3 billion. The deal represents a 36% premium to Arconic's closing price on February 27th. Arconic makes part of the parts for aerospace, automotive, and other industries. And PacWest is trying to calm markets after a 60% stock plunge that made it the new focus of concern over regional banks. The bank says that core deposits have actually increased since March. It also confirmed it's talking with potential investors. Shares plummeted yesterday after Bloomberg reported PacWest was considering strategic options. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
All eyes turn to the U.S. job market.
There are already some signs the labor market is going to weaken.
We've just started to see recently claims just tick a little bit higher.
This Friday, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
This is a really, really good report for minorities.
Can we get a painless disinflation?
This is a chairman that wants a 4.x% unemployment rate. The microdata doesn't show that.
The April Jobs Report, Friday on Bloomberg Television and Radio.
No one should assume that the Fed can protect the economy from the potential, short and long-term effects of a failure to pay our bills on time. It's essential that the debt ceiling be raised in a timely way. Failure to do that would be unprecedented. We'd be in uncharted territory, and the consequences to the U.S. economy would be highly uncertain and could be quite averse.
That's the warning from the Federal Reserve Chair Jerome Powell there yesterday in the news conference following hiking interest rates by 25 basis points and signalling there was a discussion on a pause, but not a decision on a pause. Wait for June for that, the middle of June 14th. And I think we've said a few times already this morning, who knows where we are June 14th and how many banks have failed between now and then.
That's an overlay over the debt ceiling debate. I mean, that's got a June 1 date on it in the Zeitgeist this morning. And it's a really good point, John. You got two overlay stories that are calendar items out to June. I don't think that's a small matter.
Could be in a very, very different position. I think we all hope that we're in a better position in the equity market right now. Negative 0.3. Why would you hope we're in a bad position?
Because it's bank after bank. What are the banks tomorrow?
No. Tom, language is important. So allow me to say something and then you listen. That's how conversations work.
Right. Thank you.
I hope it will be a better situation, because why would I hope it would be a bad one? I'm not saying it will be. I'm not saying it's likely to be. I'm not saying it won't be.
Oh my God!
This goes back.
Did you hear? Did that go just in it and out the other?
No, I go back to 1986.
Oh my goodness!
This is unraveling like 86 this morning. And did we expect to see First Horizon come out here 2 hours ago? No. And what's tomorrow? Boom.
I've got no idea. I'm not saying it's going to be good. Are we not allowed to hope that it might be better?
I hope things are better, too.
Thank you, Lisa.
I support that, and I also hope we resolve the debt ceiling.
Thank you.
And we potentially get stability.
It doesn't mean any of us think we will.
Bramo optimism.
Dear me.
Bramo, move on. Let's go.
That was painful. Okay. The S&P 500, negative 0.4%. TK, Anne-Marie's up next. Take it away.
3-month 10s, 187 basis points is the hope for this morning. Anne-Marie Horton is hoping in Washington, where she is our Bloomberg Hope correspondent. Anne-Marie, I am thunderstruck by the immediacy of June 1st. I guess it's a calendar item, but truly explain for our global audience what June 1st suddenly means for your Washington.
Well, that's the date that Secretary Yellen has put out, that the U.S. will exhaust these extraordinary measures they've taken to pay our past bills. Some Republicans are saying they think it's a little bit too conservative and maybe she's trying to get everyone in a room. But that's the date from the Treasury Department that they are very concerned about. And why you're starting to see a lot more angst in Washington, particularly with some people, not everyone, is because that leaves only a few working days for this president to be in Washington at the same time as Speaker McCarthy and at the same time as Senate Majority Leader Chuck Schumer to hammer out a deal. It's actually just 7, including a weekend day. Now, things and plans can change, but the president does have some foreign travel. Obviously, the Senate and the House have a number of days that are on recess. So that is why everyone is concerned. And all eyes will be on this meeting on Tuesday with congressional leadership at the White House. But if you were listening to Karine Jean-Pierre yesterday, the president's press secretary, it sounds like the president is preparing to give Speaker McCarthy more of a lecture than actually having a negotiation.
If we say the cliche, kick the can down the road, translate that in Washington speak right now.
Well, this is what Mike McKee said yesterday. When you run out of land, build more land. So this is potentially one option. The Wall Street Journal actually talks about some of the reporting they have about the White House scrambling to get potentially this option on the table. But many analysts have been saying this to me for weeks. And this is a way, actually, both sides can claim victory. So what they would do is have a short-term extension of the debt ceiling and say, in that time, we'll negotiate. Well, that would then nicely come to the other deadline they have of striking a deal on government spending. So potentially in the fall, September 30th, they can link these two together, have a short-term increase of the debt ceiling, discuss spending cuts, which Speaker McCarthy says he would not have a clean debt ceiling bill ever. He has to have fiscal spending cuts attached to that. Maybe they can do all of that in September, and then each side can claim a little bit of victory. The issue, of course, would be some House Republicans would then have to take 3 votes on raising the debt ceiling. That is going to be incredibly challenging, and that could be a revolt for the Speaker from some of those hardliners in his conference.
And Marie, is anyone actually talking about using the 14th Amendment to just singly go it alone with President Biden, just simply saying we are not legally allowed to fail and default on our debt?
It's been dangled out there. There has been signals of potentially the White House looking at every single option, including that one, to make sure they do not default. I think at the moment, these are those Hail Mary potential moments, and we are just not there yet. I think things will become a little bit more clear after this meeting the president has with congressional leadership, most notably Speaker McCarthy on Tuesday.
Yeah. And Marie, meanwhile, amid all of the debt ceiling discussions, we do hear that President Biden has nominated someone to fill Lael Brainard's seat, Philip Jefferson, who was nominated, I believe, last year and rose to be one of the Fed governors. He also nominated Adriana Kugler to fill the role on the governor board. I'm wondering, why now, especially right after the Fed meeting? Is there some sense of timing here?
Why now? Why not months ago? I mean, when we first heard and reported, including myself, about Lael Brainard moving over to the National Economic Council, I first heard about that the end of January. We are now in May, and this isn't even official yet. Josh Wingrove and Kate Davidson scooped this yesterday. Likely the administration will make this announcement on Friday. But I think it's fair to say they dragged their feet a bit, and they are behind when it comes to these nominations. Again, Lael Brainard took over that job at the White House at NEC in February. One issue the administration have is they were under immense pressure from Senator Bob Menendez and some other Democrats for the first ever appointment of an individual, an economist from the Latino community to join the board. And that really kind of changed some of the direction that the White House was taking with who they were going to and how they were going to look at the new makeup of the Fed board. And that's why you see this happening now and not potentially a month or 2 months ago.
MH, thank you for the update. Anne-Marie, down in Washington. On the latest on the debt ceiling, the composition of the Federal Reserve, and finally securing some nominations, potentially getting them confirmed for this Fed board going into the next meeting, which is in the middle of June. We're looking potentially for them to signal a pause. Although I go back to something I said a little bit earlier, Tom. The people who think this is a pause still think this is a pause, and the people who think they're going to keep hiking interest rates, still think they're going to keep on hiking interest rates.
It's a really, really good point. And of course, I go to the point where we didn't hear anybody talk about multiple meetings of pause, which is where some would suggest they need to get too fast. But you're absolutely right that the people looking for higher rates in some form did not give way yesterday.
You know what's interesting? The debate around recession within the Federal Reserve. This whole idea that the staff are forecasting a recession, and you've got the chairman coming out, Lisa, and saying, I think it's more likely we won't have one than we'll have one.
And that's what counts as dissent on the Federal Reserve. He
right
basically
now,
was saying, I mean, let's just be really honest. He basically said, this is healthy, this is great. It's so good that they can have their opinion and I can have mine. Mine is right and mine wrong. And I'm not necessarily going to knock it down here, but that's basically what we're going to follow. And isn't it good that everyone can have their own opinion? And yet, a completely unanimous decision, even though Austin Goolsbee has been pretty vocal about really questioning the logic of raising rates by 25 basis points yesterday.
A million years ago, I had a whole series of interviews with Jeffrey Frankel of Harvard, who's the guy who took us away from a strict interpretation of what is a recession. And the answer is it's squishy enough now where I disaggregate and say what portion of America is in recession right now. Commercial real estate deal makers, they're in recession right now. There's no question about that.
Would you say, Tom, this is a difference in analysis at the Federal Reserve, or just a difference in the individual making the call because of what they need to signal versus what they're actually thinking?
The answer is both. There's a lot of the need to signal going on. There's a lot of that.
I do wonder. You never hear Fed officials say recession just around the corner.
No, they're not allowed to say that.
Because they believe that becomes self-fulfilling.
Well, Neil Kashkari has been pretty vocal about that, though, but not necessarily the head of the Fed.
Right.
That's true.
It's a problem.
It is.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
From New York City, this is Bloomberg Surveillance, where we hope things are just really bad. And if you don't understand that joke, I'm not going over it again. Here's the equity market on the S&P 500. We're negative 0.3%. On the NASDAQ, we're totally unchanged. I know some people sitting there thinking, yeah, finally you said it. Yeah.
Said the quiet part out loud.
In the bond market, let's get to bonds. 2-year, 10-year, 30-year. Going into the ECB a little bit later this morning, 45 minutes from now. We're looking at the 2-year at 381 and the euro shaping up as follows in the FX market. Go on, Lisa. You got this. You got this.
110.
Thank you.
Has been, I mean, you could make some story about, well, it's a little bit stronger
close to 111
today.
last week. Give us some credit, all right?
Wow. You know, but honestly, I mean, to come up with a story, congratulations, and you're doing, you know, amazing work coming up with some narrative every single day. It's about whether it ticks up for 2 basis points or down, but it's been in this range for quite a while.
Appreciate it. Just keep throwing cold water on my
Jane Foley, we never even got to it, but Jane Foley this day of the ECB says we grind back to 106.
We killed it with her.
You know.
We spoke to an FX strategist and never asked about foreign exchange.
Yeah, that's great. You just nailed that.
Great
That's the kind of day it is.
Hour. Let's try and do better with PacWest. Let's bring up that name. That stock is down this morning.
Stocks with Winnie Caesar.
Negative 36% on PacWest right now. The latest news on a serious note, our team reporting that basically they're weighing a range of strategic options. The bank itself has come out with a pretty lengthy statement, actually. It's worth a read. A lot of detail in there about deposits and how things have stabilized. They say this about our story, essentially, that the company has been approached by several potential partners, Lisa. Investors as well. The discussions are ongoing. The company will continue to evaluate all options to maximize shareholder value.
And talking about deposits, it doesn't look that bleak, which is why it's interesting that shares are down as much as they are. And then not only for them, but pretty much anyone who's remotely associated with them, those shares are down too. Take a look at Western Alliance, another one of those banks that really have been under fire. Those shares down 14% in pre-market trading. Why? Because they've been lumped in with PacWest. I mean, there's really no other reason. And you could see this throughout the regional banking space. First Horizon, though, a bit idiosyncratic here, sorry, down 44%, but just simply because of the story here, which is the TD Bank has agreed with First Horizon to terminate the previously announced merger, which had been agreed upon, let's be honest, before all the turmoil in the banks. And I'm just going to suggest they were very excited to get out of this deal at the price that they agreed to pay. I mean, just speculating.
Well, 2 points. One, possibly, quite possibly, and you're right to raise that point. But two, it is somehow linked to the broader story, potentially, because they keep talking about the lack of regulatory timetable and implied that wasn't associated with the deal, which implies that it's something else, and we know what the something else might be.
But that's actually a great point, because what it raises is, will there be some sort of regulatory shifts that are coming sooner than later with respect to some of the regional banks? Before we move on, just want to bring in Shopify, not in the banking sphere, but they released earnings where they said that they're cutting jobs for the second time in less than a year. And basically the CEO saying, I don't want to bury the lead. After today, Shopify will be smaller by about 20%. They also are selling off their logistics business to Flexport to try to compete with Amazon. And this really talks about consolidation at a time where bigger is stronger.
The stock is up 16% in the pre-market. The other big one after the close, of course, the biggest weighting on the S&P 500. Apple earnings coming out a little bit later. Payrolls report due tomorrow. on the heels of the Fed rate hike yesterday. Winnie Caesar of Credit Sites has this to say: we think the bar for a June rate hike is pretty high. We would need to see a significant upside surprise in economic data, whereas July seems more in play to us. Tom, that's interesting. We have long expected the Fed to hike to levels close to current levels and then hold for an extended period, meaning that the current rate cuts priced into the market in the second half, drum roll, Tom, seem a bit early.
I would go there. July 26, past Labor Day to September 20, November 1, and that dreaded final meeting of the year, December 13th. This is the conversation of the day for global Wall Street and the short-term paper market and what we see in liquidity and solvency. Winnie Caesar, expert at this and global head of strategy at Credit Suisse. Thank you so much for coming in, given the distortions that we see in the market. Folding in the word pause and what it means looking out in your comments, as John just mentioned, what is the key distortion now in terms of what we care about? Liquidity and solvency in the market. How threatened is liquidity in the market? How threatened is solvency in the market?
We think still that liquidity is the big issue. Solvency definitely has its challenges. I think that those challenges are much more isolated. We see that in the CCC universe. We see that in some pockets of commercial real estate, some pockets of the leveraged loan universe. But liquidity, cash has been king, and liquidity is being distorted by the Fed, by uncertainty around the path for rate hikes, by uncertainty around the debt ceiling. We're all seeing the distortions in the T-bill market as well, which is very much directly linked to these liquidity issues and expectations around the debt ceiling.
I got ways to go here, John. Can we make this a 3-hour conversation? Bring up the bank board Lisa just brought up. On radio, it is 3-storied banks with 3 different stories. And Winnie, this all folds into your expertise. The idea of a Beverly Hills bank that got LA real estate, they got maybe paper. John says deposits are okay. Western Alliance, a bar chart from Bloomberg out on Twitter this morning showing their commercial real estate exposure. First Horizon was sort of a southern, again, local feel as well. Fold that into the question of solvency.
So in terms of solvency in commercial real estate in particular, one of the benefits is banks are going to work with their clients. They don't want to own distressed real estate. They don't want to be owners of distressed properties. And so if you look actually back to the great financial crisis and what happened with commercial real estate then, things actually worked out okay. Yes, there were some defaults, there were some workout situations, but it was not a broad-based systemic issue that took things down. I realize that the pandemic has very much changed how we're looking at office space and valuations, especially at higher yields. But in terms of kind of banking exposure to commercial real estate, and our banks team has done a lot of really great work on this, they're not super concerned that this is a broad-based, another domino yet to fall in kind of the line of issues that we've seen so far.
What would concern you? What would you need to see that would concern you that you're not seeing right now?
So I think in order for things to get really concerning, we need to see capital stop flowing to the parts of the market where it should flow. Investment grade bond market close, right? That's usually consistent with big freezes. And we saw that on the heels of Silicon Valley Bank for, a full 5 or 6 days where the bond market issued 0 bonds, which was a little bit unnerving. But we thought that was much more related to issuers saying, whoa, 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 we're going to sit on the sidelines. We don't need to step into this mess. We can wait it out and see. And a lot of that is because they were so proactive last year, even amid all the market volatility, and issuing an awful lot of bonds. And we think that that kind of two-way flow is still pretty indicative of credit conditions. While they've tightened, they're not necessarily super rolling over at this point.
Let's put those two ideas together. What would it take for you to recommend buying the bonds of some of these regional banks?
Well, we actually are. So our banks team has come out with an overweight allocation to banking in general in the U.S. They have some pretty significant calls in the regional banking system. They are kind of viewing valuations as much more attractive than they had been. They're not saying buy everything, right? This is a very credit specific. You have to really be in the weeds, understand what makes these banks tick. And I think part of the problem is banking is confusing. A lot of people do not understand how banks operate, how they make money, how they repay their debt. And so our banking team is very constructive.
Would you push back against people who say there needs to be some sort of policy response to act as a stopgap measure with some of the distress and the rumors that are percolating through these share prices and setting them lower? Do you think that that is unnecessary based on the strength and the vast majority of the sector?
I do think that the recent situation highlights how much technology, social media, information flow has changed how bank runs look, especially because you can now go on to your app, move your deposit from one bank to another really easily. And that's for, small individuals, large corporations. There's a much lower bar than there used to be in terms of actually kind of moving around deposits. So I don't necessarily think that we need to have some sort of widespread regulation, but I think that the information flow still needs to improve in terms of why these things are happening, how banking really works, and some of the complications and problems that have been created by, social media really going after banks in general.
Winnie Caesar of Credit Suisse. Winnie, thank you. Thank you very much on the credit market, on the banks as well. Some of these banks, Tom, they were investment grade, and all of a sudden they were junk very quickly.
This idea of liquidity and solvency is critical. And, we're making jokes about 2008, but it's the same debate then as it was in 1907 or whatever. Liquidity and solvency are two very, very different emotions. And what's been shattered here, frankly, after the ballet yesterday that we witnessed with Jerome Powell, is confidence. And what I would suggest is there's no discussion, to Goolsby's point, of the efficacy of a duration of pause to help heal the system while we wait for them to get the underlying economics to bring rates down. I mean, that's what the market wants. They want the Fed to turn around and move, and that takes time. It takes delta T on the x-axis. So you got to pause. I don't hear that discussion going on.
Well, let's be clear, Tom. Pausing at 5, I think we've found the bite point for the regional banks, haven't we?
Yeah, I believe we have.
I think a lot of people
you
might
nailed
say
that.
It's here. It's 5%. And Lisa, if it's going to be 5% persistently, then there's going to be problems. And that doesn't mean that more banks are going to hit the wall. You guys at home can make your own call on those kind of things. But ultimately, you can see the direction of travel here, that these banks are struggling to retain deposits because you can get 4-5% elsewhere. And if they've done a load of lending where those assets are yielding, 2-3, can you pay out for deposits of 4-5? It's difficult.
That's the reason why you're seeing the bigger banks do better, because they've got a bigger critical mass. But it raises this issue, and we talked about this with a number of people who have come on the show. Is it the speed of how much the rates went up, or is it the level? This is really unknown to me. If it's the speed, then all of a sudden people are shocked to realize all at once, wait a second, we could get more. If it's the level, this is an existential problem that will become more and more evident, especially as the economy starts to deteriorate.
The ECB decision just around the corner. At about 8:15 Eastern Time, we'll catch up with Katrina Dudley of Franklin Mutual reacting to that decision. Looking forward to that conversation. Then about 30 minutes after that, we get an ECB news conference. We've got a lot to get through. After the close, we talked about this a few times. We get Apple earnings a little bit later, but a focus at the moment, again, on the US banking system. Equity futures, pretty resilient. Tom, I think this is what's amazing about the index. The index supported by these big tech names, which have delivered on earnings. We've not just had a resilient equity market. The S&P 500 rallied through March, and it rallied through April in the face of lenders going under in this country.
I strongly agree. And what it is a bear market SPX back to level. I mean, we went from negative 20% up to near flat on SPX. And you see it with all this turmoil that's going on, the VIX is still under 20. I find that remarkable. And we got the emotion here today of a VIX of 28. We're nowhere near that.
Lisa, I just want to go through these headlines as well from TD Bank and First Horizon. So TD Bank and First Horizon have agreed to terminate this $13 billion merger. This is essentially because TD couldn't offer a date for this to close because they don't have a timeline for regulatory approval. The story right now is First Horizon down 39%, TD positive 1.4%. Your equity market negative 0.3%. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Federal Reserve Chair Jerome Powell hinted the U.S. Central Bank's latest 25 basis points interest rate increase could be the last, suggesting that officials may pause their tightening in June. But Powell pushed back against any expectations that the Fed will be cutting rates by the end of the year. Bloomberg's learned that President Biden has picked Fed Governor Philip Jefferson to be promoted to vice chair. The selection could be announced as soon as Friday. Meanwhile, economist Adriana Kugler will be nominated to an open Fed board spot. She would be the central bank's first Latina policymaker in its 109-year history. A new poll says almost half of adults in the U.S. worry that their bank deposits aren't safe. That's a level of concern as high or higher than during the 2008 financial crisis. The Gallup poll was conducted last month following the failures of Silicon Valley Bank and Signature Bank. TD Bank and First Horizon have agreed to terminate their $13.4 billion merger agreement. In a statement, the two banks said there was uncertainty if and when regulatory approvals could be obtained. As part of the termination agreement, TD Bank would pay First Horizon $200 million. Shares of First Horizon plunged more than 40%. The e-commerce company Shopify is selling the bulk of its logistics unit to Flexport. The transaction includes the sale of the shipping service company Deliver, which Shopify bought last year for $2.1 billion. In return, Shopify will get a stake at 13% in Flexport, and Flexport will become Shopify's official logistics partner. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
So let's go inside the boardroom. Let's suppose you win a proxy fight and or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with the plan.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question. Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
The focus is on inflation. They're trying very hard to separate financial stability concerns, banking system concerns from monetary policy. We'll see if conditions force them to begin to combine financial stability concerns with monetary policy decisions. As of today, they did not do that, and they don't appear to believe they have to do that.
It's a good summary of the current Fed and their position from a former Fed official, Dennis Lockhart, formerly of the Atlanta Fed. From New York City this morning, good morning, about 30 minutes away from an ECB rate decision. Will it be 25 or 50? 25 appears to be the consensus. 50 is the call from SocGen. Going into all of that, the FX market shaping up as follows on the euro. It's Lisa's favorite currency pair right now.
100%.
110.68 on the euro against the dollar, totally unchanged. Let's see if we get some moves a little bit later. In the equity market, we're negative 0.3%. We've got to go back to the story of the moment. PacWest in a pre-market trying to stage some kind of bounce recovery. It's still negative 36%, ugly. Off the back of reporting from our colleague, the brilliant Matthew Monks, reporting that PacWest has been weighing a range of strategic options, including a sale, according to people familiar with the matter. That has been confirmed by the company itself, essentially, with a statement overnight into this morning saying the company has been approached by several potential partners and investors. Discussions are ongoing, Tom. The company will continue to evaluate all options to maximize shareholder value.
Each of these stories is different, and as John has mentioned through the morning, the deposit stability seems to be actually pretty good at PacWest. Joining us now, our reporter Matthew Monks, after he moved markets and truly moved all of banking markets last night. Matthew, congratulations on your report. reporting as simple as I can. In the April 25th statement by the leadership of PacWest, they say that credit dynamics are steady. I found that really, really, really important. What are the credit metrics they have? Is it real estate on Rodeo Drive? What do they actually own away from the deposits?
They have a lot of commercial real estate, so that's like multifamily apartment loans. They have a lot of business loans, like so revolving credit lines to businesses. They have a venture capital lending business. The important thing to understand here, this is not a credit quality issue. Not yet, at least. It's an interest rate issue, which means that these loans are no longer, worth what they were when they wrote them. Their market value is below par. But they're assuming that they all get paid back. They will be worth whole eventually. But it's really about the interest rate, and the credit quality is holding steady, which is different than the last crisis.
So Matt, let's talk about these strategic options. Go through them one by one, what is on the table here and where you think the priority lies for leadership at this bank.
So the ideal solution here would be some kind of rescue merger with another larger institution. It's a great franchise in California. There's a lot of people that'd be interested in expanding in California. But the issue, like I said, it goes back to this kind of interest rate risk in those loans. Since they're not worth what they used to be, any potential buyer is going to have to take a substantial hit right out the gate, marking down those loans, which would create a loss. So it makes it really, really hard for someone to buy them. So obviously that would be the first priority for them, is to find a merger partner, but just getting someone to take that hit would be an issue.
Matt, we just saw the playbook with this, right? I mean, we just saw the idea that basically you just wait for the FDIC to come in and give you some sort of loan loss agreement, and then all of a sudden it's a feasible purchase. Why is this not just going to end up in the same place?
I don't know yet. If you can, I don't know. I'm trying to get my head wrapped around it as well. Now, there is one possible reason. Now, this is a much smaller institution than First Republic. It's much smaller than Silicon Valley Bank. So potentially, a bank could kind of step up and eat a loss and make it worth their while. But it's kind of hard to argue with, getting a sweetheart deal from the FDIC, I guess. But it's all still to be determined.
Matt, I don't want you to tip your hand, but I know that you speak with a lot of people in the world of deal making. How much chatter is there about additional M&A, about additional kinds of tie-ups in the banking sector, perhaps under less distressed kinds of circumstances, to get ahead of this type of thing?
I think everything's dead right now for the reason that I mentioned. I think long term, you're going to see a lot of consolidation, but right now everything is just kind of off the table, and especially when you see that TD deal unraveling this morning. If you're a large institution, how are you going to take that risk that it's going to get shot down? These deals take 9 months to begin with. Now you're going to do a deal and it's just going to be open-ended. So no, I mean, I hate to say it, but unless it's kind of forced or distressed, bank M&A right now is dead.
I mean, I don't want you to play sell-side analyst here. That's not the Bloomberg way, Matthew Monks. But in your reporting, even if you have deposit stability from $35 billion down to $28 billion, is the other side of the ledger so diminished mark to market that they're at a net capital negative right now? I mean, is PacWest sitting with zero capital?
No, I don't think so. I don't think they're insolvent. And everybody that I was talking to last night, wasn't indicating that they're solvent. I mean, it's about investors and shorts selling down these banks and just being merciless. All the institutional investors have fled. You're not really seeing bargain investors kind of get into the stock. It's just investor sentiment that's just hammering these banks. I mean, the three larger banks that failed before, these were really incredibly problematic banks with the $100 billion of troubled assets on their balance sheets. It's not the case here. This is really, it's actually a really nice franchise in pretty decent shape. It's just getting pummeled by investors.
Matt, the deposit profile is so different compared to SVB, and we can put some numbers on that with ease. We did that a little bit earlier. From a reporter's perspective, for you, are you focused on that? Are we focused on the right thing when we sit here and say deposits have stabilized, which is something the bank itself wants to communicate?
On that, and absolutely. And I'm going back to the point that I think 80% or so of their deposits are insured. That liquidity is not just going to run off in a heartbeat. And these are insured kind of retail and commercial deposits. I don't think that we're seeing a run on them. So yeah, I'm absolutely focused on that. And that's why I keep putting this message out here that it's a different situation than some of these other institutions.
One of the listeners of the program had an amazing question, which is essentially what you're saying, that the Fed has to cut rates to get bank consolidation to take place. Is that kind of what people are waiting for, that opportunity for perhaps a balance sheet that makes a little bit more sense?
Yeah, well, I mean, people are waiting for maybe the government to raise the deposit insurance cap. That's one thing that could kind of just stabilize things and then maybe create stability for M&A. The Federal Reserve, slowing its roll when it comes to interest rates. Yeah, at this point, the private market is definitely waiting for some kind of guidance from the government to stabilize things, to foster consolidation one way or the other.
Hey, Matt, wonderful to catch up with you, sir. Tremendous reporting. Matt, let's talk again soon.
Thank you,
before the week is out. Thank you, sir. Matthew Monk's there on the latest story with PacWest. If it's the case that you have, and the number, by the way, is 75%, insured deposits total 75% at PacWest. If that's the case, does a shift in the FDIC limit even mean anything to a bank with a profile like that, a deposit profile like that, Tom?
No, it's not about
FDIC.
Say no, right? It's about, as he was talking about, the commercial real estate, and the best chart out there is from Chris Whalen. I can't remember where he got it from, but it just shows the mark-to-market losses summed across the banking industry now, and that's not why I'm gloomy and without hope. But the answer is, I look at the conversation with the guy hasn't slept in 3 weeks. Let's start with that.
Great report.
And the answer is, people like Matthew Monks are trying to sort out things these banks don't want to talk about or don't want to value. That's to me the key thing.
Just one target to the next in this market. It's brutal stuff. We used to talk about the bond vigilantes. We're sort of going into banks right now, one to the other. You go from First Republic, we've gone to PacWest.
Problem that I see is, I don't see a resolution unless you get yields coming in, right? And that's, I think, what the issue is that yields were too low for too long. This, a lot of people would argue. I'm not saying this. I'm reflecting a consensus that a lot of people would say. And then all of a sudden, you have an entire loan portfolio pegged to a very different interest rate era. Right. So to this point that the terminal raiser, that the viewer raised, how much are we looking at waiting for a Fed rate cut to solve a problem that otherwise is only going to get worse?
On a calculus basis, the way I put this is, you're correct, yields have to come in, but if you go, John, pause, whatever, pause, that's a net present value rate cut while you wait for the Fed to see the ex post data to then finally cut rates. That's not in the zeitgeist this morning. Multiple pauses, except maybe from Goolsbee.
This is all if you believe this is just about deposits and rates.
I agree. It's not. It's not.
And your point this morning, Thomas, you don't think it is.
I would hope that would be the mention that I was hoping earlier.
I'm done. Chris Turner of ING is coming up to talk about the ECB decision. That decision drops in about...
We hope he'll show up.
20 minutes my God. I think he's going to. In the equity market, I think.
I hope.
We're negative 0.3% on the S&P 500. PacWest is down about 40%. ECB up next. 30 minutes after that, a press conference with ECB President Christine Lagarde, who's going to say our financial system is sound and resilient and strong and all of that stuff. From New York, this is Bloomberg.
What do you say to the cynics that say, look, it's all nice and fine, but a lot of it is greenwashing, and you're not a good company, you're just a less toxic company than some of the other oil majors?
Well, the first thing to say is that, I'm a big believer in we need to put ourselves in other person's shoes in life in general. And so I understand that point of view, and I get that people have that perspective. I don't agree with that, obviously, but I understand where they're coming from. We have an enormous challenge as society, which is to provide the world with reliable, affordable, and clean energy. That's what society wants. That's what society needs. And I believe in my heart that a company like BP is actually one of the few companies in the world who can actually make that happen. We can talk about the things that we're going to grow and over the coming years, and I find it hugely exciting and energizing for our organization. But that's what the world needs, and you simply can't go against the grain of society. You can't defy gravity, and that's why we're making the change that we're making.
Our studios in New York and San Francisco, our expert hosts of the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right? And
Yes.
making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
But are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
These stresses in the banking sector are likely still there. They're likely still coming. They're likely still tightening financial conditions as we look ahead.
You cannot say that it's completely separate what's going on in the banking sector relative to hitting the inflation goal.
I think the main thing on the June meeting is we can't rule out further policy rate hikes.
I do think the goal coming into the meeting was to give themselves the option to pause.
I think they can pause and then continue to tighten again if the data turns out to support that.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio and television, commercial-free in this half hour with a meeting of the European Central Bank. We're looking at bank crisis in America. We're looking at Apple coming out this afternoon. John, none of it matters right now. What matters is Christine Lagarde and her carefully mentioned words in the press conference.
Inflation still hot. They're set to go 25. That's the estimate in our survey. Some banks out there, including SocGen, think they might go 50. Inflation's hot, but we're starting to see things happen in the banking sector. Lisa touched on this in the last hour. The Eurozone Bank Lending Survey showed a real tightening in lending standards, Tom. And I wonder if we see the same thing from the United States in the next week when we get that senior loan officer opinion survey we've all been waiting for.
We haven't talked about it. I saw a nice chart here. Yes, inflation elevated in Europe, but even in the angst part of it, it's rolling over ever so slightly. You talk about ex ante, ex post, given the politics of Europe, different from the Fed, how ex post does Lagarde have to be?
Well, Germany does not want to see 5. They don't want to see 6, 7, 8, 9. They certainly don't want to see double figures again in Germany either. I think there's going to be a key difference, though, for this ECB. They're going to make the point that their banking system, compared to what's transpiring and materializing, evolving in the United States, is very different.
Yes.
They're going to say we haven't seen banks fail in the same way the United States has, and I think they're going to make the point that they can keep policy where it is for a long time. And I think the ECB might have the option of making people believe them in a way that perhaps they didn't with Chairman Powell, given what's developing with PacWest this morning.
This is your wheelhouse in your ute, and the basic idea here is a Landesbanken equivalent in Germany their banks aren't as entrepreneurial. They're not as equity-driven and as growth-driven as the growthiness that got us into this trouble in America.
Well, the epicenter of this, and there are loads of different stories in the banking system in America, but I think we need to focus on California. And Tom, I think you've done a great job of looking at what's happened with Silicon Valley, all the lending, the massive growth in deposits through the pandemic as some of these institutions, all of this happened so quickly, and then bang, 0 to 5 at the Federal Reserve, just like that. And so many management teams have been caught really offside by that, Tom, and those banks have gone under.
So much to focus on here, folks, but in this half hour, we're really going to focus on what's going on in Europe. Lisa, just your thoughts holistically. It's a much more fixed income mindset over there. Diamond talks about Fortress JP Morgan. All of Europe is a fortress compared to the leverage that we see within the U.S. system.
Just to build, though, on what John was talking about, this idea that in the U.S., the problem was how quickly the rates were raised, and then that really challenged business models that had grown up during a very different interest rate environment. I wonder if Christine Lagarde today is going to hint at that and is going to opt for a 25 basis point increase rather than a 50 basis point increase, and a more moderate kind of pace of increasing, just simply because the lesson from the United States might suggest that perhaps you could have more breathing space to raise a little bit more gradually.
If we get hawkish instead of hawkish pause, I mean, Lisa's the expert on this, John, but does Euro pop to a 111, 112? I mean,
hey, we came close to 111 last week. I'm not going to make an FX call for you this morning, that's for sure. But certainly, if you can encourage people to believe that you're going to go again and again at a time where the Fed is almost communicating a pause, then certainly rate differentials open up in a different way.
To the data check to get to Chris Turner of ING. John, we haven't mentioned it all morning. I'm sorry, American oil, $68.56 a barrel gets my attention.
Breaking down, 68 handle on WTI. Bond yields higher, rising by 2 basis points on a 10-year, 335.24. Much lower yesterday and the day before, though, off the back of some of this banking stress. Just to round things out, equity futures negative 0.4% on the S&P 500. Tom, going into Apple earnings a little bit later on.
We'll have to see on Apple at 4 o'clock. Look to Scarlett Fu, Romaine Bostic for that coverage in the 4 o'clock hour. Joining us right now, steeped in economics and accounting, is ING Bank's Christopher Turner. Chris Turner is Global Head of Markets Research for all of ING. Chris, I look at the ballet. We're completely focused on the Powell ballet of yesterday. The Lagarde ballet to me is so different. Really, how different is a challenge Christine Lagarde has this morning, given the turmoil?
Yeah, I think she'll very much focus on delivering what we think at ING will be the 25 basis point rate hike that you've been discussing on the show already today. But I think the message will probably be a little bit more kind of hawkish than clearly what we saw from Jay Powell last night. I mean, services inflation seems to be a lot more sticky in the Eurozone, and even though they won't sort of pre-commit for another 25 basis points in June, actually we think they will hike in June, but I think there'll probably be enough in the press conference and the tone of the language to emphasise that the door is very much open for further hikes.
The job is not over for this ECB. They're a single mandate central bank, as you know well, Chris, and quite clearly they're falling short of it with inflation at 7% in the Eurozone. Now, Chris, going on from here, I think what we're starting to see in the US is a struggle in some parts of the financial system with 5% interest rates, at the regional banking level specifically. Chris, when you look across the Eurozone, the financial system, the economy, any sign of that developing whatsoever from your perspective?
It's certainly kind of not clear. And I think, the point you raised earlier, that sort of differentiation at the moment between like the US and the European kind of banking sectors. And that's something that the IMF brought up in its Global Financial Stability Report recently, looking at the stock of debt securities on US banks' balance sheets relative to Europe, with those being sort of much higher in the States. So I think very much the focus at the moment is on what you've very well been describing, the sort of stress in the system and how it's moved to pack west, and what it's meant for interest rate differentials as well, with those US rates crumbling at the moment.
Is the regional banking crisis or issues that we're seeing in the United States perhaps analogous not to the banks of Europe, but to the real estate of Europe, that perhaps is more interest rate sensitive in a more immediate way than in the United States?
Yeah, we haven't been seeing that. I mean, as a theme, I mean, it has been mentioned, particularly places like Scandinavia, in terms of kind of perhaps the leverage in the particularly the commercial kind of real estate area. But I think in broader, on the residential side, that really hasn't sort of cropped up as an issue for markets at the moment. So I think the focus very much is front and centre on the US regional crisis at the moment.
Based on that, Chris, why not just be really bullish on the European region? Because it means that you could have an ECB that's fighting inflation, but a resilient economy that, as we saw from some of these services data this morning from a number of different European countries, is coming in hotter than expected.
Yeah, and I think as Jonathan mentioned earlier, there is a case for euro-dollar to be trading a lot higher. Those yield differentials are narrowed to the narrowest spread this year at about kind of 65 basis points at the 2-year part of the curve. And that does make a very strong case for a higher euro-dollar. And I think that will be the core story this year. The euro-dollar trades up to 115, maybe higher. The challenge, though, that we see, particularly in FX markets, where I concentrate my activities, is what's happening with like US money markets and the cross-currency basis swap, which is starting to show some signs of nervousness again. And that's clearly not good for the risk environment. And I think with investors pretty long euro-dollar already, particularly asset managers, I think they're probably thinking twice about adding to positioning at these relatively high levels.
Chris, how would you expect, and I think it's an important issue, the US dollar to behave, or how would investors behave towards the US dollar if we went into a period of risk aversion, and that period of risk aversion was dominated by the United States? At the epicenter of that risk was the US. How would the US dollar react to that?
Yeah, it seems counterintuitive, doesn't it, in terms of, as you say, the US is kind of the source of the problem. But we have seen when, particularly conditions in money markets, so we are very much closely looking at things like the 3-month euro cross-currency basis swap, seeing if there's any signs of stress in terms of investors and banks wanting to secure dollar funding and paying over the odds to get that dollar funding. That is widening kind of slightly, and also looking at the FRA OIS spread for any signs of money market stress. But if those spike out, which they do on occasion, actually the dollar counterintuitively performs quite well. So in our sort of analysis, we've been sort of recommending defensive currencies. We think things like the yen and the Swiss franc, those with very low correlations to the S&P 500. Those are probably the currencies you should be kind of overweight at the moment. But you could see some counterintuitive dollar strength, particularly against activity currencies. Canadian, for example, the Canadian dollar could be exposed if the risk environment really deteriorated.
Interesting, Chris. Thank you, sir. Chris Turner of ING on the FX market and what would happen if we get a period of risk aversion, Lisa, and the US was the source of that risk aversion?
It's a great question. It's something that a lot of people are trying to understand. Are we in a new regime where there suddenly is less preeminence of the dollar in terms of the global currency? A lot of people have come out, tried to debunk that, saying it still is the main currency that is used for all transactions. The IMF coming out pretty vociferously about that. But even with all of that, there is a different kind of environment if the U.S. is the source of the weakness, as you well highlighted.
I don't think they're going to look at the U.S. They are so wedded to the tensions of a core Central Europe, Germany, to the Netherlands. John, you mentioned Austria to me the other day. How is the Bundesbank going to react to this? The core question here, away from that, is given this shocking where ECB rates are, John, I still can't frame it.
That's amazing. I'm totally with you, Tom.
But I asked Gentilini this at the IMF meetings of Italy, and I said, where's the nominal GDP, the animal spirit to support this interest rate structure? And I'm waiting to get an answer from an expert. That's my first question to Lagarde today, and it goes back to eurosclerosis. Are we really beyond it?
There was a time in the depths of the pandemic, I remember speaking to, I think, Bob Michael at JP Morgan Asset Management. Do you think that the ECB will go through another cycle without hiking interest rates? Remember, Draghi did a full, 8 years?
Yeah.
And never hiked once. Never hiked once. And I thought perhaps Christine Lagarde is going to repeat the act, and here we are looking at 4% over at the ECB, which is quite amazing, Lisa.
It shows just how much we underestimated inflation and how nobody imagined this type of inflationary impulse that we have not seen for 40 years.
I'd go one step further. That plus, I don't think many people thought that this bond market would tolerate it, particularly on the periphery in Italy.
Tolerated so far.
Well, yes. We hope.
we hope it's tolerated it, yes.
All of that good stuff.
You brought that back.
Chris Turner of ING, just brilliant, thank you. Equities negative 0.4%, the ECB decision coming up.
keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. Federal Reserve Chair Jerome Powell has opened the door to a June pause for interest rate hikes. Policymakers raised rates for the 10th time since early last year, and Powell hinted that might be the last one. But he stopped short of declaring victory in the fight against inflation. Bloomberg's learned the European Union is discussing a new sanctions mechanism. It would target third countries that it believes aren't doing enough to prevent Russia from evading sanctions. The process would focus on those that can't explain spikes in trades of key products or technologies. Apollo Global Management has agreed to buy Arconic, which makes parts for the aerospace, automotive, and other industries. The all-cash transaction has an equity value of about $3 billion. The deal represents a 36% premium to Arconic's closing price on February 27th. And PacWest is trying to calm markets after a 60% stock surge that made it the new focus of concern over regional banks. The bank says that core deposits have actually increased since March. It also confirmed it's talking with potential investors. Shares plummeted yesterday after Bloomberg reported PacWest was considering strategic options. Bloomberg's learned that President Biden has picked Fed Governor Philip Jefferson to be promoted to vice chair. The selection could be announced as soon as Friday. Meanwhile, economist Adriana Kugler will be nominated to an open Fed board spot. She would be the central bank's first Latina policymaker in its 109-year history. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
About 50 seconds away from an ECB rate decision going into it. Here's the shape of markets right now for you on the S&P 500. Slightly negative through most of this morning. We are negative 0.3% on the S&P. Looking at the bond market shaping up as follows. Yields a little bit higher at the front end of the US curve on Treasuries, 382, 1 basis point higher actually. Outside of all of that, looking at foreign exchange, euro against the dollar, 110.79, very close to intraday, year-to-date highs on a single currency. Came very close to 111 just last week. We're positive there, Lisa, by a little more than 0.1%.
And that is a really good way to characterize it, because I've been sort of mocking that we've been around the 110 level for about a week now, but it actually has broken out, and it is at a higher level. So there is a question of whether it can break out even further, especially given the conversation we just had with the resilience.
I'll ask for the euro quote from you in just a moment as we anticipate that ECB rate decision. This is what we're looking for, a 25 basis point move from the European Central Bank. Last time around, big conversation about 50 or 25. This is the move right now. It's 25. They go from 350 to 375 on the main refinancing rate. The deposit facility, which has got a ton of attention over the last 10 years, 3% to 325 from the European Central Bank. So that is a 25 basis point hike from the ECB. The inflation outlook continues to be too high for too long. The ECB hiking interest rates by 25 basis points. Just a quick look at the euro, still in and around, guess what, 110.68 right now. The underlying price pressures remain strong, Lisa. The inflation outlook too high. Just on the APP, the asset purchase program, they expect to stop the APP in reinvestments as of July. Past rate increases are being transmitted, they say, forcefully. A ton of headlines coming through, Lisa. What have you got?
Well, people definitely, I'm just watching the euro, frankly, because you told me to, but I also am watching it because it is sort of feeling that pressure upward as we have a very clear sense that inflation is the preeminent concern. What I do find interesting, though, is how little response you're getting in markets, as you really do have this feeling that the press conference is going to be really key to indicate how much further they think they need to go, how much they're going to try to backstop peripheral bonds, how much they're going to try to create some issues to mitigate some of the potential pressures from the market response we haven't not seen
Just
yet.
going to work through some of the statement for you. They're the initial headlines and some of the price action. Just opening up the statement from the European Central Bank. Overall, the incoming information broadly supports the assessment of the medium-term inflation outlook that the Governing Council formed at its previous meeting. Headline inflation has declined over recent months, but underlying price pressures remain strong. At the same time, they go on to say the past rate increases are being transmitted forcefully to Eurozone financing and monetary conditions, while the lags Going to hear that word a lot. And strength of transmission to the real economy remain uncertain. They go on to say the Governing Council's future decisions will ensure that the policy rates will be brought to levels sufficiently restrictive to achieve a timely return of inflation, Tom, to the 2% medium-term target, and will be kept at those levels for as long as necessary.
Kept, is it French for pause? I mean, you know, I wonder here about the pausiness of all this, and I don't hear it. I hear the Bundesbank here saying inflation's what it is, and we really need to. There's a vigilance here I didn't hear yesterday.
I think there's a line there, Tom, that's important. It just implies there are a few steps behind where the Federal Reserve is at.
Yeah.
By saying this, that future decisions will ensure that the policy rates will be brought to levels sufficiently restricted to achieve a timely return of inflation at 2%, implies there's more to come here, Lisa.
Which I think was the large expectation because they are so far behind what we saw with the Federal Reserve. Just taking a look at the market response, I find it interesting that two-year yields in Italy are rising, not incredibly, but just a little, while two-year yields in Germany are coming down, not incredibly, but just a little bit. And this, to me, is the divergence to watch as that peripheral region really does start to come under pressure.
I can't show and tell this, John, in real time here. It's too important to get to Katrina, but it's really important to understand nominal GDP in Europe, the Eurozone as it's defined, is where it was in 2008. Granted, it's up off the bottom of like the middle of the last decade at 3% per year, but it's a shadow of what you see in terms of the animal spirit of the United States. And this is Italy behind and other countries. You're better at this than I am, but I just don't think you can apples and apples the Fed and the ECB. I think there's two stark different stories.
Let's get over to Frankfurt and catch up with our colleague, good friend, Maria Tadeo, on the latest decision. Maria, you've had a chance to go over this one. What jumps out for you?
Well, Jonathan, it was 25 basis points. Remember, we had a lot of data this week which pointed to core inflation cooling in April. That was seen as a key factor going into this decision. Obviously, that would show that the transmission is working, and core inflation, which we know it's not the target, but is the number that they really focus on, that played a part in this decision. And then you also had that lending survey that came out 2 days ago, which kind of showed credit conditions were really also tightening in the euro area. A lot of this providing the basis for a downshift, which is 25 basis points. There's a number of lines here that are also interesting where they say, obviously, inflation is still unacceptably high. That points that there is more to cover. It'll be interesting to see whether or not she paints a sequence. For the time being, they just say, we will stay data dependent. And overall, to me, the question was, would they go 50? Was that still in play, or actually go for a downshift? And they've gone for the most cautious approach.
Maria, wonderful to get your perspective. We'll catch up with you after the news conference. That's going to begin in about 25 minutes time or so. I have to admit, when I was working through the statement and you read this line that the past rate increase have been transmitted forcefully to Eurozone financing and monetary conditions, the lags and strength and transmission to the real economy remain uncertain, kind of tease up what you think might be a pause, and then you read the next line. The future decisions will ensure that the policy rates will be brought to levels that are sufficiently restrictive. That tees up another move down the line, doesn't it?
One more and then hold or something. Basically,
maybe, who knows?
All I can say is how lucky is Christine Lagarde that she goes after Jay Powell, that she gets to learn from how the market responded to everything that he did and listens to all of his comments, and then can be like, okay, don't do that. Okay, yeah, do that. And then she can come out and nuance the statement.
Well, they just so happen to be behind in the process, Tom. It's not just about the calendar coming after him a day after. I know what you're saying.
No, but it's true.
They're behind in the process as well.
Yeah, they're behind in the process, but it's a completely different political mix. And John, the inflation numbers I'm witnessing, which frankly you and your family are living in the United Kingdom and Europe, they're nowhere comparable to the United States. Take the worst story, worst anecdote in the United States, and it's a walk in the park compared to what citizens are feeling in Greece or the United Kingdom or Finland.
Well, we can have this conversation with our next guest.
Yeah,
has much better clarity on that than I do. Katrina Dudley joins us now, portfolio manager at Franklin Mutual Series. Katrina, can we start there? The difference in the inflation that the Eurozone is experiencing right now and that we are here in the United States, is there a big difference from your perspective?
We need to think about what's generating the inflation in the Eurozone region and what has been generating it. And the war in Ukraine has really not come to light for such a long period of time. But that's really what is reflected in those European inflation numbers. It's the fact that someone cut off the gas supply and we needed to replace that gas. And that is the inflation that people are dealing with. But we keep talking about it, and I think it's so important. It's the reality reaction of the governments that we have been very, very positive upon in terms of that incremental help that they're providing to their citizens. And I think that that is where there's that disconnect, is that the population is actually quite happy because they're getting support and they're getting help, so they're not protesting in the streets.
What's fascinating to me, and this came up at the meetings of the IMF, and we have Lagarde. John, when is Lagarde? Like in an hour?
8:45.
Oh, so like
so 23 minutes.
Yeah, yeah, it's going to be here in a brief. She's speaking a different language to a different culture and fabric. And I wonder, within all your study, Bond University, all the work you've done in equities, are we at a point where we can say they've gone beyond eurosclerosis and that they have a financial structure more like us, more Anglo-Saxon, if you will, than what we knew when we were studying this?
It's transitioning. I think that the bond market in the Eurozone is still not as robust as the bond market that we see in the United States. And what does that mean is that, companies don't go into bankruptcy that is driven by the bondholders and the breaching of those covenants, because the debt is held in the banks. And the banks tend to be wanting to work with their customers on a longer period of time. So even though you've had that transition, it's not been a really noticeable one. But look, they're data dependent. I mean, who does not want to hear the fact that the people running the ECB are looking at the data and they're being informed by the data, and they're saying that the core inflation number is still high. It's at 5.6% on a core basis. That's significantly above 2. We're not talking the difference between 2 and 3. We're talking multiple points higher, and they need to, I think forcefully was the word, but they need to really push that number down.
So we haven't stated it yet, but data dependency is a key phrase on the show, where you're going to have an alarm go off and then we'll say, well, what exactly do you mean by that, right? And it means something different for everybody. For right now, the Federal Reserve, it means the Senior Loan Officer Survey and perhaps what happens with respect to regional banks. In Europe, is it just core inflation? Is that the preeminent data dependency that we're looking at?
I think that they're looking at multiple of factors. They're looking at what's happening in spreads in the periphery, and we saw that about a year ago, where you saw that blowout in spreads in Italy, and the ECB reacted. So that's one area of data they're looking at. They are looking at inflation. They're also looking at Eurozone in your employment metrics, because one of the mechanisms for inflation, it needs to be wage adjustment, because people need to get that to be able to cope with it. And so they're looking at whether or not those higher wages are causing employees to be laid off. So there's a lot of different factors they're looking at.
Katrina, thank you for jumping on into the studio and catching up with us. Thank you. Katrina Dudley there, Franklin Mutual, on the latest ECB decision. 25 basis point hike. News conference about 20 minutes from now. The euro, the single currency against the dollar, 110.50 on the euro, with negative 0.1%. Lisa does not get the move that she was hoping for.
Well, what? Break out of 110? Oh, no, I want this to stay at 110 for another 2 weeks.
Another 2 weeks.
Yeah, it makes it easy.
At least. Coming up in the next hour on Bloomberg TV, following the news conference from the ECB, Alessio De Longis of Invesco, and, drumroll, Megan Green of the Kroll Institute. Megan, of course, selected to join the MPC at the Bank of England as an external member on a 3-year term, beginning later this summer, I believe, Tom. So very cool to catch up with her ahead of that.
Really cool to catch up with her, and she has a transatlantic reach and policy that I'm sure will be of benefit there. I love the way but the Bank of England does it better than the Fed.
You've said that.
They got Catherine Mann. They got Megan Green.
You like that they have external members.
I do. I like that they had Adam Posen. I like they had David Blanchflower, on and on.
I hear you. I hear you.
I feel it.
Well, you said that, not me. In the equity market, on the S&P, we're negative 0.4%. Live from New York, this is Bloomberg.
big ideas. We show the productivity increases that are possible because of artificial intelligence. It's these companies who could be some of the biggest beneficiaries if they harness AI correctly. I think a lot of people are looking for the killer app, like they look like these viral apps that the internet delivered. The killer app for artificial intelligence is productivity gains, and any company does not harness it is probably not going to be one of the big winners out there. And just one other thing on AI. The real winners here are going to be those companies that have proprietary data and have lots of it, have the best domain expertise, best AI expertise, the best pools of high quality data to basically create new businesses.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Good morning, everyone. Bloomberg Surveillance, Lisa Bramwitz and Tom Keene, John Farrow preparing for the next dashing hour of what we do here. We've got lots coming up, including important claims data onto the jobs report tomorrow. And I'll be looking at unit labor costs. Someone here to give us wisdom is Lisa. Did you notice once again McKee made the chairman pause yesterday?
And then not answer his question.
Did you see how he did that?
I love that. And then say, but what about the cuts?
Exactly.
He had to then say after
there's a hawkish pause and then there's a McKee-ish pause, and we got that yesterday. Right now, without further pause, Michael McKee on today's data.
Well, Tom, jobless claims front and center because the Fed, of course, is worried about inflation from wages and the tightness of the labor market. 242,000, a major rise from last week's 230,000 drop. The forecast was for 240, though, so it isn't hugely out of line, but it does show a little bit higher baseline for jobless claims. Tom wanted to know about unit labor costs, up 6.3% in the first quarter. Non-farm productivity overall down 2.7%. So not good news on the productivity and cost front. Does show inflation pressures remain. And then the trade balance comes in at negative $64 billion. That is down from negative 70.6. So it's one of the reasons, and we saw this in the data, that the first quarter growth came in a little bit higher than we had thought.
I want you to get to unit labor costs. Stephen Rasciuto is going to help us out here in a moment, Mike, but let me have your word on it. I know productivity is really moldy, to be polite. Are unit labor costs a proxy for inflation?
They're a proxy for, I would say, a contributor to inflation, and it's a backward-looking number because it's quarterly, so it incorporates January, February, and March. But basically, it's telling you that there were labor cost pressures, higher labor cost pressures in the first quarter than in the fourth quarter, and that is something that we already knew. Now the question is, what do we see in the second quarter? Does that go down? Because according to the data that we've had on wages and salaries, they have eased a little bit as the quarter went on.
And this is something that Jay Powell himself really spoke to, saying he doesn't believe this is the main driver coming from the wage picture yesterday. I do want to just get your sense, Mike, about what Jay Powell did say to your question about why the market is consistently pricing in rate cuts before the end of the year, even though the Federal Reserve is insisting upon holding rates where they are for the foreseeable future.
Well, the market seems to be betting that we're going to see inflation fall faster than the Fed anticipates. The Fed thinks it's going to be a very slow process, that they've got the low-hanging fruit. Well, the market thinks either the Fed is going to be very successful in what it's doing, or we're going to go into recession. In either case, inflation goes down a lot, and the Fed's going to be forced to cut rates. I don't think Powell wanted to spark the market reaction that he did in answering my question by leaving open the possibility it could happen. But it is possible if the inflation data break the right way for them.
Mike, you were as rude as we always expect. Michael McKee, thank you so much, running all of our economic coverage here, and of course, it's important questions to the chairman yesterday. Here's what we're going to do in the next half hour. We are commercial free to you worldwide on radio and television. In this hour, we're going to go to the Lagarde press conference. Yes, we'll have first word news. But right now, to get us there, Stephen Risciuto joins us. Steve Risciuto is chief economist at Mizuho, and yes, it is on the American economy. But Stephen, I've got to start with the EU here and the challenges that Madame Lagarde faces. The idea here is the animal spirit of the United States, our technical superiority, say Apple earnings this afternoon is one example, gives us a certain, as Ned Phelps of Columbia would say, dynamism. Does Europe have the dynamism to have a higher interest rate regime?
Well, part of the problem that they face is all the conditions that you just laid out. But in addition, there's a demographic issue. And there is a wage subsidy issue, which certainly adds to the whole concept of the whole Eurosclerosis discussion that we had been having for years about Europe. And I think Europe is aging rapidly, and they're finding a way not to keep their best educated people on the sidelines in a very comfortable lifestyle.
Lisa, I want to note the Euro craters here. I mean, this is widely anticipated by John Farrell. The Euro craters, as I would say on the radio, to a 110.21.
Yeah, to 120. Yeah, exactly. Here, this is what I'm watching, actually. It's exactly the chart that I have up, not just because I'm waiting for it to break out of the 110 range. But Steve,
to be proven correct.
I'm curious. I don't know what correct would mean for me at this point, but I am curious about whether, Steve, you think people have overplayed the Europe strength story, the ability to withstand both higher rates and consistent growth that was sort of the consensus heading into this meeting. And then all of a sudden, they took the lesser of the two options with the ECB today. And then in the U.S., you see that the data is still strong. Does this underscore something that is important?
Well, I think there is that measure. And I think when you're looking at the oil numbers, yes, I know people are talking about a fat finger mistake in terms of the decline in oil. But I think what you're seeing is globally around the world, you're not seeing the kind of resilience. You're not seeing it coming out of the Chinese opening. You're not seeing it coming out of Europe. And I think, yeah, there's a greater potential for Europe to run into resistance, especially as I heard one of your commentators talking earlier today about the fact that Europe has a much closer connection in terms of its mortgage environment relative to the interest rate environment than we do in the United States, because we have fixed rate mortgages, they have adjustable rate mortgages, and the net result is they have a bigger economic impact from what's going on.
Well, let's build on that, because I was wondering whether their mortgage situation is akin to the regional banking situation in the U.S. You need the nodes of stress that are emerging are distinct depending on what kind of capital markets each region has. Do you think that the mortgage issue in Europe could become the new regional banking crisis in terms of people unable to pay for their monthly bills?
Yeah, without getting into the specifics of it, I think at this particular juncture, I think you're probably okay. And one of the reasons for it is because of the social safety net that's created in Europe. But I think in addition to that, you're in an environment where, people in Europe are quicker to adjust their spending as a result of this. So I think, you're looking at a potential downturn in the economy relative to the strength everyone was looking for. Am I going to say it's going to be a deep or significant downturn at this particular juncture? I can't make that call. But I do think it adds to the growth, to the recession forecast, as the regional bank problem adds to the recession forecast here. And if you look at all the data we've gotten out this week, a lot of it's March data, some of it is April data. It's all strong. Even when you look at the claims number this morning, 242. Between 250 and between 200 and 250, you're not in a recession. That's residual. You got to get into that 250 to 3 area to start saying, okay, it's a really shallow recession, and then you keep on going up from there. And then you look at continuing claims, they dropped again. So, we don't have that labor market issue that I think a lot of people are concerned about yet.
If you're just joining us on radio and television, Stephen Risciuto of Mizuho with us. We could go for 3 hours with him with the experience of the American economy. Let's turn to America right now. I want you to dovetail in with your colleague Dominic Constam's idea of a Fed with monetary policy, but with other stuff, including the banking crisis, becoming, as Constam states, super restrictive. How close are we to Risciuto super restrictive?
I think the Federal Reserve has a way out of this that would be very, very simple. And I think one of the things that they should do immediately is end quantitative tightening. Part of the problem in the overall scenario for the outlook for the U.S. economy is the fact that the Federal Reserve is taking down its balance sheet. And the Fed seems to believe taking down its balance sheet will not lead dollar to dollar to taking down reserves. It is taking down reserves. And the net result is that's amplifying the problems. So the Federal Reserve, this is the second time they've attempted to do both an interest rate increase and a quantitative tightening, and they've blown it both times.
Okay, but is this like a British austerity? The United Kingdom buried itself with some, philosophical 20th century austerity a number of years ago. Do we have an austere Jerome Powell?
Well, I think the Federal Reserve is overplaying its hand by using both quantitative tightening and interest rate policy at the same time. They should separate the two. They should use one at a time, and they should recognize that largely when you go into a quantitative easing standpoint, you do it and you assume it is permanent because you've done it because you're afraid of deflation.
Most key point for the press conference will be that they are ending reinvestment of the APP, basically one of their main bond purchasing, asset purchasing programs. And this was sort of a nod to the hawks to basically say, okay, we are going to get rid of this program more quickly, even though we're not going to raise rates by 50 basis points. What are you looking for in terms of what Christine Lagarde has to say about this?
Again, I think they're going to go down the same path that we've gone down. There is this misconception that what you put in, you can take out. When you're looking at the reserves in the system, the bank's balance sheet expands to the level of reserves that are provided. And it's harder to shrink the balance sheet than it is to expand the balance sheet. And this is why the Fed thinks, well, if we put it on automatic pilot, we let it run in the background, everything's fine. Okay, that's fine to some extent, but you're also raising interest rates. So the reality is separate the two. Leave them as separate policies because they are distinctly separate policies, guided for very distinctly different things. So I think what the Fed should do, and I think what the ECB should do, is leave one alone, do one, and then come back to the other. The ECB so far has only focused on one. The Fed was doing both at the same time. We've gotten into a problem with less taking out of the system now than we did in 2018 and 2019.
Don't be a stranger. Stephen Rusciuto with us with Mizuho, just a terrific team between Steve Rusciuto and Dominic Constam over at the Japanese bank. Lisa, we've got to look at the data here, and my head's spinning on the 2-year yield. I think it was 4.XX 2 cups of coffee ago, and we were at a 380, and now we're back up 4 basis points to 384. And I would suggest that was on unit labor costs, which are an original statistic right now for me. I don't have that chart in front of me, but
coming in at 6.3% versus the expected 5.5%. This is sort of the key issue, that inflation still is remaining hot, and the labor market is not cracking to the degree that people thought that it might. I mean, to Steve's point, initial jobless claims coming in at 242, but revised lower the week before. So this is definitely pointing to ongoing sort of strength in non-recessionary types of labor markets.
And this goes to what Luzzetti talked about at Deutsche Bank yesterday, and also Bill Dudley of the New York Fed, and now with Bloomberg Opinion, this idea of if you pause, is it asymmetric or can it be symmetric? Dudley was heated, as I think Steve Rusciuto is, that you can have a pause and go either way. And certainly this inflation data gives them room to move here in June, July, or on to whatever the next 7 meetings are as well. Here's what we're going to do. Stay with us on radio and television. We are going to go to First Word News and then a conversation of the European press in Frankfurt with Christine Lagarde. We'll bring you that in I'm thinking 3 minutes we'll bring you that. Christine Lagarde in 3 minutes. Stay with us. This is Bloomberg Surveillance.
Keeping you up to date with news from around the world with the First Word, I'm Lisa Mateo. Federal Reserve Chair Jerome Powell hinted the U.S. Central Bank's latest 25 basis points interest rate increase could be the last, suggesting that officials may pause their tightening in June. But Powell pushed back against any expectations that the Fed will be cutting rates by the end of the year. A new poll says almost half of adults in the U.S. worry that their bank deposits aren't safe. That's a level of concern as high or higher than during the 2008 financial crisis. The Gallup poll was conducted last month following the failures of Silicon Valley Bank and Signature Bank. A judge has dismissed Donald Trump's $100 million suit against the New York Times over an award-winning report on his taxes. The judge also ordered the former president to pay the paper's attorney's fees and costs. The Times report said the Trump real estate business claimed suspiciously low valuations on properties to minimize tax liability. In Atlanta, police have arrested the suspect in a fatal shooting at a medical building after a manhunt that lasted several hours. They say he stole a vehicle after the attack and later fled on foot, and one person was killed and 4 others wounded. The suspect's sister says her brother was not mentally stable. The Canadian e-commerce company Shopify is taking more steps to recover from last year's slump. The company is cutting jobs for the second time in less than a year. It's also selling the majority of its logistics business to Flexport. CEO Toby Lutka says that after today, Shopify will be smaller by about 20%. At the end of last year, the company had 10,000 employees. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Good morning, everyone. Particular good mornings in Europe to you. Christine Lagarde to come up momentarily with the European Central Bank. Lisa Bramowitz and Tom Keene on radio, on television. We welcome all of you around the world to an extraordinary day. American banking crisis. Apple will have, Romaine and Scarlett will have it for you later on, I should say 4 p.m. But Lisa, the focus now is on Lagarde. I didn't realize this. Time has marched on. She is a pandemic head of the ECB, joining just before the beginning of the pandemic.
Which it really highlights how unique her moment really was and how different it was from Mario Draghi in his reign, when he didn't have to deal with inflation, when he didn't have to deal with some of these issues and was able to manage through a crisis without raising rates.
8 years at the International Monetary Fund, getting high marks in the last press conference for the verbiage, the nuance here as well. What's the nuance that you will listen for from Lagarde today?
I think what Maria today pointed out was a really good one. What is the significance of the ending to the reinvestment of the APP, one of the key asset purchasing programs that the ECB started? I also am curious about the threshold to hike versus the threshold to hold. How concerned are they about credit tightening in their system? So far, the reaction to this release has been yields lower, not only in Germany, but now in Italy as well as a weaker euro versus the dollar.
The promptness to the Lagarde appearance here, the 3 podium set up on the stage here, the obligatory photo op, done differently than we do it in the United States. I don't see Michael McKee in the front row chomping. Why do I have to go so late in the press conference, McKee would say. But our Bloomberg reporters are assembled with the others in Frankfurt. Maria Tadeo there, of course, on the watch to sum it up through the morning. And these will be extremely important comments of the political divisions that Lagarde had, Lisa, as a French minister. She's familiar with the fractiousness of Europe.
The politics of this, right, to bring people together and understand the difference. Although in this case, there's actually more unity because the inflation is much more widespread. It's not just one country. More pernicious, more widespread, more of a significant concern. So it's not necessarily as heated of an issue to raise rates and tighten policy at a time when you do have such pernicious inflation.
And of course, the overlay here is there is a war in Ukraine. We're about ready to get set here on radio and television. I should note futures at -10, yields higher off American productivity data. An important moment, euro weaker here in the last number of minutes. So 110.20, euro on the move. Beginning comments here as we go to Christine Lagarde. Let's jump in right now.
And by Vice President de Guindos. And my name is Wolfgang Preußel. As always, this is a hybrid press conference. So for the online participants, I would ask them to turn on their camera and their microphones if they wish to ask questions. And with that, I turn over to President Lagarde. Please.
Thank you very much, and good afternoon. The Vice President and I welcome you to our press conference. The inflation outlook continues to be too high and for too long. In light of the ongoing high inflation pressures, the Governing Council today decided to raise the 3 key ECB interest rates by 25 basis points. Overall, the incoming information broadly supports the assessment of the medium-term inflation outlook that we formed at our previous meeting. Headline inflation has declined over recent months, but underlying price pressures remain strong. At the same time, our past rate increases are being transmitted forcefully to euro area financing and monetary conditions, with the lags and strength of transmission to the real economy remain uncertain. Our future decisions will ensure that the policy rates will be brought to levels sufficiently restrictive to achieve a timely return of inflation to our 2% medium-term target, and will be kept at those levels for as long as necessary. We will continue to follow a data-dependent approach to determining the appropriate level and duration of restrictions. In particular, our policy rate decisions will continue to be based on our assessment of the inflation outlook in light of the incoming economic and financial data, the dynamics of underlying inflation, and the strength of monetary policy transmission. The key ECB interest rates remain our primary tool for setting the monetary policy stance. In parallel, we will keep reducing the Eurosystem's asset purchase program portfolio at a measured and predictable pace. In line with these principles, the Governing Council expects to discontinue the reinvestments under the APP as of July 2023. The decisions taken today are set out in a press release that is available on our website. And I will now outline in more details how we see the economy and inflation developing, and will then explain our assessment of financial and monetary conditions. Looking at the economic activity, the euro area economy grew by 0.1% in the first quarter of 23, according to Eurostat preliminary flash estimate. Lower energy prices, the easing of supply bottlenecks, and fiscal policy support for firms and households have contributed to the resilience of the economy. At the same time, private domestic demand, especially consumption, is likely to have remained weak. Business and consumer confidence have recovered steadily in recent months, but remain weaker than before Russia's unjustified war against Ukraine and its people. We see a divergence across sectors of the economy. The manufacturing sector is working through a backlog of orders, but its prospects are worsening. The services sector is growing more strongly, especially owing to the reopening of the economy. Household incomes are benefiting from the strength of the labor market, with the unemployment rate falling to a new historical low of 6.5% in March. Employment has continued to grow, and total hours worked exceed pre-pandemic levels. At the same time, the average number of hours worked remains somewhat below its pre-pandemic level, and its recovery has stalled since mid-2022. As the energy crisis fades, governments should roll back the related support measures promptly and in a concerted manner to avoid driving up medium-term inflationary pressures, which would call for a stronger monetary policy response. Fiscal policies should be oriented towards making our economy more productive and gradually bringing down high public debt. Policies to enhance the euro area's supply capacity, especially in the energy sector, can also help reduce price pressures in the medium term. In this regard, we welcome the publication of the European Commission's legislative proposals for the reform of the EU's economic governance framework, which should be concluded soon. Turning now to inflation. According to Eurostat's flash estimate, inflation was at 7% in April, after having dropped from 8.5% in February down to 6.9% in March. While base effects led to some increase in energy price inflation from minus 0.9% in March to plus 2.5% in April, the rate stands far below those recorded after the start of Russia's war against Ukraine. Food price inflation remains elevated. However, standing at 13.6% in April after 15.5% in March. Price pressures remain strong. Inflation, excluding energy and food, was 5.6% in April, having edged down slightly compared with March to return to its February level. Non-energy industrial goods inflation fell to 6.2% in April, from 6.6% in March, when it declined for the first time in several months. But services inflation increased to 5.2% in April, from 5.1% in March. Inflation is still being pushed up by the gradual pass-through of past energy cost increases and supply bottlenecks. In services especially, it is still being pushed higher also by pent-up demand from the reopening of the economy and by rising wages. Especially, it is still being pushed higher also by pent-up demand from the reopening of the economy and by rising wages. The information available up to March suggests that indicators of underlying inflation remain high. Wage pressures have strengthened further as employees, in the context of a robust labor market, recoup some of the purchasing power they have lost as a result of high inflation. Moreover, in some sectors, firms have been able to increase their profit margins on the back of mismatches between supply and demand and the uncertainty created by high and volatile inflation. Although most measures of longer-term inflation expectations currently stand at around 2%, some indicators have edged up and warrant continued monitoring. Let us now look at our risk assessment. Renewed financial market tensions, if persistent, would pose a downside risk to the outlook for growth, as they could tighten broader credit conditions more strongly than expected and dampen confidence. Russia's war against Ukraine also continues to be a significant downside risk to the economy. However, the recent reversal of past adverse supply shocks, if sustained, could spur confidence and support higher growth than currently expected. The continued resilience of the labor market, by bolstering household confidence and spending, could also lead to higher growth than anticipated. There are still significant upside risks to the inflation outlook. These include existing pipeline pressures that could send retail prices higher than expected in the near term. Moreover, Russia's war against Ukraine could again push up the costs of energy and food. A lasting rise in inflation expectations above our target, or higher than anticipated increases in wages or profit margins, could also drive inflation higher, including over the medium term. Recent negotiated wage agreements have added to the upside risks to inflation, especially if profit margins remain high. The downside risks include renewed financial market tensions, which could bring inflation down faster than projected, weaker demand, due, for example, to a more marked slowing of bank lending, or a stronger transmission of monetary policy would also lead to lower price pressures than currently anticipated, especially over the medium term. So let's look at the financial and monetary conditions. The euro area banking sector has proved resilient in the face of the financial market tensions that arose ahead of our last meeting. Our policy rate increases are being transmitted strongly to risk-free interest rates and to the financing conditions for firms, households, and banks. For firms and households, loan growth has weakened owing to higher borrowing rates, tighter credit supply conditions, and lower demand. Our latest bank lending survey reported a tightening of overall credit standards, which was stronger than banks had expected in the previous round, and suggests that lending may weaken further. Weak lending has meant that money growth has also continued to decline. Summing up, the inflation outlook continues to be too high for too long. In light of the ongoing high inflation pressures, the Governing Council today decided to raise the 3 key ECB interest rates by 25 basis points. Overall, the incoming information broadly supports the assessment of the medium-term inflation outlook that we formed at our previous meeting. Headline inflation has declined over recent months, but underlying price pressures remain strong. At the same time, our past rate increases are being transmitted forcefully to euro area financing and monetary conditions, while the lag and strength of transmission to the real economy remain uncertain. Our future decisions will ensure that the policy rates will be brought to levels sufficiently restrictive to achieve a timely return of inflation to our 2% medium-term target, and will be kept at those levels for as long as necessary. We will continue to follow a data-dependent approach to determining the appropriate level and duration of restriction. In particular, our policy rate decisions will continue to be based on our assessment of the inflation outlook in light of the incoming economic and financial data, the dynamics of underlying inflation, and the strength of monetary policy transmission. In any case, we stand ready to adjust all of our instruments within our mandate to ensure that inflation returns to our medium-term target and to preserve the smooth functioning of monetary policy transmission. We are now ready to take your questions.
Thank you, President Lagarde. And the first question goes to Annette Weisbach from CNBC. Annette, please.
Thank you very much, President Lagarde. I have, of course, 2 questions. My first question would be on the rationale behind the reduced pace in the interest rate hike of 25 basis points. So why did you come up with that? And my second question goes to the U.S. regional lender banking crisis, which isn't over yet. So how concerned are you about potential spillover effects to the euro area? Thank you.
Well, thank you for your question. I will take the first, and maybe I will ask my colleague and friend, Vice President Luis de Guindos, to address the second one. So let me tell you a little bit about the mood in the room of the Governing Council. I would characterize the mood as determined. All governors are determined to fight inflation, tame inflation, and return it to 2% medium term. And we all concluded, as you have seen, that the inflation outlook is too high and has been so for too long. I would say then that the mood was very focused, and yet it is an in-between projection Governing Council meeting. But we were extremely attentive to all data that was available to us. And obviously, one case in point is the bank lending survey that you all received or saw on Tuesday when it was published, and which contains a lot of intelligence and information about the intention and the comparison between the lending practices and standards with what was expected by the banks, and I'm happy to come back to that later. But it explains, obviously, the decision that we made for this 25 basis point increase. I think in terms of method, we were method dependent in many ways, just as we are data dependent, because we have articulated the reaction function of our monetary policy decisions with the three key elements of the inflation outlook informed by the financial and economic data, the underlying inflation, and the strength of monetary policy transmission. So we checked all the data that we had against these three criteria. And as is always the case at the Governing Council meeting, there was a variety of views expressed. And I think that it's fair to say that everybody agreed that increasing rate was necessary, that second, we are not pausing, that's very clear. Third, we know that we have more ground to cover on the basis of the baseline that we had, which is still guiding us until we have our next projection exercise, and on the basis of the data that we have received in the course of the last few days and that we brought together during the meeting. So I think the ultimate balancing act, which received almost unanimous support, and that is reflected in the monetary policy statement in front of you, was really predicated on the methods, the data we received, the understanding that where we are is totally consistent with the baseline that we had for the outlook last time around. Remember, at the last March meeting, that's what I said. And second, that underlying inflation is still high. And third, informed by the bank lending survey and the data that we have concerning interest rates, which is a little bit outdated because it goes back to February, the transmission of our monetary policy is working, at least to the financing leg. And we're not yet certain about the next leg, which is transmission from banks to the real economy. So it's on the basis of all that that we made our decision. Now that we have increased rates significantly and sometimes by very large increments, I hope establishing absolute credibility on our determination. It was sensible in view of what I have told you to return to a more standard increment with the understanding that based on the information we have today, we have more ground to cover and we are not pausing. That's extremely clear.
Good afternoon. Turning to your second question, I think that we should start by a consideration. If you look at the characteristics of the US banks that are running into difficulties, I think that there are some common features. The first one is that they are medium-sized, regional. They share a very concrete and very idiosyncratic business model, and they are quite open to interest rate risks. They are vulnerable to an increase in yields. And I think that this model, this situation is not extrapolatable to the European banking industry. Well, I will not repeat what we have said many times. The European banks are resilient, the level of capital, the level of liquidity, the quality of the liquid assets. But I think that simultaneously we have to remember that an increase in interest rates, in yields, is positive for the European banks because the increase in margins outweighs the potential losses that this increase in yields could cause in fixed income portfolios. But I think that it's quite clear that there is no space for complacency. One of the things that we have been all of us surprised is about how rapidly a bank run can take place and how rapidly a bank can be emptied. And I think that this is the combination of new factors. The first one is digital banking, and the second one is social networks. And the combination of both have given rise to a new situation. And I think that supervisors and regulators, we have to bear in mind that new framework because we believe that this is going to be key in the near future.
Thank you, President, Vice President. The next question goes to Francesco Canepa of Reuters. Francesco, please.
Thank you, Francesco Canepa, Reuters. So my first question is about whether anyone at the meeting insisted on a larger rate hike or on a clearer commitment to more hikes. You just hinted at that by talking about ground to cover, but it wasn't quite as explicit as it was back in the winter when you were talking about steady pace and several rate hikes. Second question is about something you just said, which is, again, that you had more ground to cover. Would you say that we are still in the middle of the journey or towards the end, in the home stretch? Thank you.
I'm tempted to remind you of the Emerson quote. It's not so much the destination that matters, but the journey. And we are on a journey, okay? And we are not pausing. And under present circumstances, and based on what we have, which is the baseline of March, we know that we have more ground to cover, okay? And there is a clear reference to that if you look carefully, and I know you have, because you do that very well. But in the second paragraph of the monetary policy statement, we explicitly refer to that by saying that our future decisions will ensure that the policy rates will be brought to levels sufficiently restrictive to achieve a timely return of inflation to our 2% medium-term target, and will be kept at those levels for as long as necessary. We have covered a lot of ground in the last 9 months, right? Moving from minus 50 basis points to plus 300 basis points. We are continuing this hiking process. As I said, this is a journey. We have not arrived yet. As to, the exact amount of, by how much do we increase rates? As I said in my introduction, in the response to the first questions, there was a variety of views. Some governors suggested that maybe 50 was appropriate. Others also believed that 25 was appropriate. I didn't hear anybody suggest that 0 would be appropriate. So that confirms to you that this is a hiking journey that we are on, and it will continue to be so. But at the end of the deliberations, and having had a chance to confront our views and to answer the questions and to really sort of put everything in perspective, there was a general, very strong consensus behind the decision that you have in front of you.
Thank you, Madame Lagarde. And the next question is for Jana Rando of Bloomberg News.
Thank you.
Morning.
Good morning.
Good afternoon.
Well, good afternoon. I would like to invite you to elaborate a little bit more on your definition of sufficiently restrictive. The IMF had a view the other day, seeing the terminal rate at 3.75%. A lot of economists do that as well. Would that be something, given the inflation outlook we have at the moment, that would be in the ballpark of sufficiently restrictive? The other question I have is that at the last meeting, you had a little bit of a debate about over-tightening and having to reverse course. And I'm wondering whether that discussion continued this time, and whether you would actually be worried that such a scenario might be interpreted as a policy mistake. Thank you.
Well, thank you very much. I don't have a magic number of what constitutes, open quote, sufficiently restrictive, end of quote. I think that the honest answer is we will know what that is when we get there. And we are in the process of moving in that direction. I think what's important is to understand, what it means to have restrictive rates and to be in restrictive territory. And I think the best example is to see whether the rate decisions that we make, the rate increases that we decide, are actually having an impact on the economic actors. And when we look at the bank lending survey in particular, or when we look at the interest rates and the pace at which it has increased in the last few months, it is obviously the fact that interest rate decisions that we made and the interest rates level where we are having an effect. Is it a sufficient effect yet? We don't know, because we are not seeing the transmission at this point in time into this, what I call the second leg of the economy, which is the real activity, which then has an impact on prices and then reduces inflation. So full cycle we're not seeing yet. We're seeing inflation coming down, don't get me wrong, because headline is coming down as a result of energy prices having coming down significantly, as a result of the easing of bottlenecks. But we're not yet seeing the complete impact that we desire in order to arrive at the 2% medium term that constitutes our target. We are very attentive. We look at that. As you know, it's one of the three components that we look at, the inflation outlook. But it is restrictive, no question about it. Is it sufficiently restrictive? Not yet.
Thank you, President Lagarde. And the next question goes to Martin Arnold of the Financial Times. Martin, please.
Thank you. Hello, President Lagarde. I have two questions for you. The first one is on the decision to accelerate the pace of shrinking the bond portfolio at the ECB. Does that mean, now that you're stopping all reinvestments in the APP, does that mean that you plan to reduce the APP to zero eventually? And the second question that I have is, was this decision part of a compromise deal to convince those arguing for a 50 basis point move to accept a 25 basis point move in return for accelerating the pace of shrinking your balance sheet? Thank you.
Well, thank you very much, Martin, for this sort of double question on the same issue of the APP. Well, I would say, number one, we made the decision, but the decision specifically says we expect. So we expect to let the APP run off as time goes by. And in answer to your question about do we go to zero, if we do, then it's going to take the next 15 years. So I don't think I'll be around for that. I know I won't, and I'm not sure that you will be around. But the ultimate perspective is that one, as we consider things today. We've decided to expect the effectiveness of that decision as of July, saving a little bit of optionalities just in case, simply because we have seen that the partial reinvestment that we decided back in, that has been effective since March, has actually run very smoothly and has been well absorbed by markets. So we don't see any point in not accelerating the move because there are valid reasons for that. Lower the amount of excess liquidity, complements our policy rate increases, reduce the side effect of a large balance sheet. All of that completely justifies the fact that the APP is let to run off gradually over the course of time, which will be an average 25 billion per month not reinvested, roughly. But as I said, to run the whole APP program to zero, it will take 12 to 15 years, given the maturities of what we have. I would just reserve one thing, because we discussed it during the Governing Council, and it's not reflected in the monetary policy statement. As you know, we have adopted a tilting approach to our investment policy of the APP, and in particular for the corporate bonds, which are the prime targets of that tilting, in order to privilege those corporates that have a good environmental footprint, that have a transition plan, and that disclose all the appropriate information about their plans. Now, of course, if we go to full runoff, that tilting process is not going to be applicable, because there will be nothing to tilt it off. There will be no basis for that. So I think the jury is out as to how we can continue to deliver on our Paris Agreement compliant reinvestment program without the reinvestment phase, and how do we address that, which is something that we agreed we would take into account and consider to see how we respond to that. Was it a deal? No. No. I think there was a general view that that was the right move, completely sensible, legitimate at this point in time, given the market absorption. I think some might have preferred to wait until the June meeting to announce it, given that it's effective as of the 1st of July. But, with the principle of predictability that we had agreed in the first place, we thought it was just better off to just announce it with reserving a little optionality on the side.
Thank you, President Lagarde. And the next question goes to Aude Kersulek of BFM TV, French television.
Good afternoon, Mrs. Lagarde. About the last banking lending survey, so is there a target for bank lending or limits in credit tightening? How do you monitor these indicators? And second question, you said recently in relation to bank failures on the Credit Suisse case that you really need to measure what comes out of this financial event. So what are the indicators that you're looking at? Would you say that there is a banking crisis? What's your view of what's happening there in the banking system? Thank you.
Yeah, on the, we know of one and only one target, and this is our medium-term target, 2%. That's what is riveting our attention. But of course, the bank lending survey that we receive on a quarterly basis informs us about the tightening of credit to the economy. And it also informs us about what the banks assess will be or will not be the tightening. And it's quite a sophisticated survey, which is really for information, intelligence, anticipation of the credit tightening now and the credit tightening going forward. It's also illustrative of the demand. And that's an interesting point, because in the BLS, the demand from corporates is really, really down. So that's, learning that we take, which indicates that our interest rate policies is beginning to have an impact. Because when asked, the corporates say, and we had the corporate survey that was conducted, they say it's the interest rates. It's not that, we don't want to invest, but the interest rates are pretty high. And that leads me to the restrictive territory or not. Yes, we are in restrictive territory, because if that is the response of corporates, then it shows that this works. On Credit Suisse, I think I'll say a few words, and then I'll ask my colleague, Mr. de Guindos, to also address that. But number one, it was addressed very swiftly. The Swiss authorities maybe did not have many choices, and it was very specific and probably a long-lasting issue that was lingering and had been lingering for a long time. So I certainly would not draw the conclusion that the merger between UBS and Credit Suisse to be decided is an indication that there is a financial crisis. Far from it. But we are learning. I think that we also learned the value of having rules, and the ability we had to come out very quickly on the pecking order of creditors actually mattered a lot. And I think that we can also take a bit of learning from that. When creditors, investors know exactly who is going to bear the brunt of outstanding liabilities and a situation of insolvency, it just helps. And we did that. I'm glad we did.
Well, just to add that on the question about the indicators that we consider, that we look at, well, we have a range of indicators. For instance, equity prices, bank bond spreads, the evolution of deposits. And we have not seen, the kind of situations that happened in other jurisdictions. So we had, let's say, a sort of, increase of tensions after, the events in the US with Silicon Valley and with Credit Suisse. And afterwards, the situation has been quite calm. So we are continuously looking at those indicators, but, clearly, now, the conclusion is that the European banking industry has been clearly outperforming the American one in terms of the tension, included in this kind of indicators, and, the potential stress in financial markets.
Thank you, Vice President, President. And turning to our online participants now, I would like to give the floor to Francesco Nilfole of Milano Finanza. Francesco, please.
Thank you. Good afternoon. President Lagarde, can you explain a little bit more how you reconcile your data dependency with the pledge?
Excuse us. Can you repeat, because we missed a few questions.
Okay.
Can I explain what?
Can you explain how you reconcile your data dependency with the pledge of doing more in the future? It can be a little bit contradictory, like forward guidance without a forward guidance. Maybe you can explain it a little bit more. Secondly, on core inflation, no doubt it is important to monitor core inflation, but the ECB's target, as you have said just now, is headline inflation at 2% in the medium term. So how do you explain such a great emphasis on core inflation, also considering that core inflation has not been a good leading indicator for headline inflation in the past? Thank you.
Thank you very much. Data dependency is not forward guidance. And I'll try to explain that for you for a second. I'm not giving you the forward guidance that come what may, or subject to, or until such time, we will do this or that. That for me would be forward guidance, okay? And we had it in the past, and it was very appropriate to have forward guidance as we were at the lower bound, and that was a tool that was very useful. What I'm telling you now is, given our baseline, the findings that we have, the data that we can analyze today, our judgment in the room is that we are not pausing. That applies to today. And based on what we see, we determine that we have more ground to cover. I'm not saying that in the abstract. I'm saying that with reference to the baseline of March, to what we are seeing in development. And I'm here saying we believe that we have more ground to cover. It is not state dependent. It is not time dependent. It is a judgment that we make today. So I hope I've been clear to try to explain to you how we can actually say that very firmly without giving forward guidance and being data dependent. Comes the June meeting, comes the July meeting, comes the September meeting, and so on and so forth, we will look at the data and we will use the 3 criteria of our reaction function for monetary policy purposes, and we will make our decision on a meeting-by-meeting basis. So, you've also asked me another question about core. We had long discussions about core, and we actually had many more discussions on underlying inflation, because core is interesting. Core is easy to communicate. You take headline, the whole basket of everything that's in the index, you take out food, you take out anything having to do with energy, and you have core. But we want to go a little bit deeper into the index and the evolution that we see, and we have multiple measurements that you are familiar with. You know, the TRIM, the PCCI excluding energy, and so on and so forth. We look at all of those, and we try to understand from the evolution that we see, what is the likelihood of inflation evolution. So, I'm not maybe addressing you core versus headline, but simply I'm saying that headline is the objective that we have, it's the target that we have, that we've agreed in our strategy review. It happens to be what matters to people. People see oil prices increasing, and we're working for the people of Europe, okay? Core, easy to communicate, but maybe not as informative as we want it to be, so that leads us to dissect in far more details inflation. Thank you.
Thank you, President Lagarde. And the next question goes to Christian Siedenbiedel of Frankfurter Allgemeine Zeitung. Christian, please.
Yes, thank you. Madame Lagarde, I'm sure many people will be interested to know whether the worst of inflation is over for food. Do you have that impression?
Thank you for that question, because it is food prices that is hurting most, particularly the most vulnerable people. And we know that because in the basket of consumption, the most vulnerable spend a lot more on food than those who are well off. So we pay special attention, of course, to food and the increase in prices. We have seen it go down, right? If you compare March and April numbers, so it is going down. But we have to be extremely attentive because there are multiple factors that apply to food prices, that apply to processed food prices. I think we have also flagged the fact that profit last year, in particular in 2022, have contributed to inflation. This year, 23, what we have seen of 23, we see more wage increases contributing to inflation. We would hope that through a good social contract, these drivers of inflation do not activate each other in what I have called in other places a tit for tat. You know, I want more wages, I'm not going to give up on profits, and you are then at risk of something that is much more difficult and would lead us to have to take more active measures in monetary policy. So I wish I could tell you, of course it will continue to go down, but I'm observing that it has gone down. There are other factors that will come into play. You know, clearly climate change is something that will have an impact, probably on a sectoral basis, probably in relation to certain food items. What happens in Ukraine is also going to bring another uncertainty in the background of cereal price in particular. But commodity prices have gone down. That is a fact. So hopefully it will channel to the ultimate consumer.
Thank you, Madame Lagarde. And the next question goes to Andres Stumpf of Expansion. Andres, please.
Good afternoon, Madame Lagarde. Can the ECB continue hiking if the Fed stops? Is that a baseline scenario you're working on? And second question, do you have any estimates on how much tightening is the QT and the TLTRO maturity adding to the monetary policy stance? Can you perhaps phrase it in hiking or basis points of hikes? Thank you.
You know, I've heard the fiscal dependency, I've heard the finance dependency, I had not heard the Fed dependency. So the ECB is an independent central bank. You know, looks at what others do around the world, from New Zealand, which has been an interesting innovator in the field of monetary policy, all the way to the Fed and others. And it's obvious that the US economy, in whichever way it evolves, has spillover effect around the world, given its size, the depth of its financial markets. But you know, we have a target, we have a journey. We know as of today that we have more ground to cover, and whatever the decision of the Fed is in the next few weeks, months, we are going to be riveted to our objective, and we'll of course take into account variables. You know, the currency, for instance, has an impact. Any spillovers will be taken into account, but we are not Fed dependent in that respect. As to the actual tightening impact that the APP runoff has, I don't want to commit a number, but it does not have a massive impact, suffice to say. But we can give you, separately the exact amount that has been calculated, but it's not material.
Thank you. And the next question goes to Anna Karismo of the Finnish television Yle.
Hello, and thank you for the opportunity, and nice to see you again. We met in Lapland. So, yeah, you have repeated that the journey continues and you are not pausing. There are many households in Finland, Lithuania, Spain, that struggle with the much higher interest rates and have had to cut down on their spending. So how do you take them into account when hiking the interest rates? And then a second one, what should they prepare themselves for? What can you say to them about the future? When can we see the policy rates going down and maybe affecting also the 12-month Euribor? Thank you.
Well, thank you so much, and it's nice to see you again in warmer circumstances. So, of course, we are aware of these households that have contracted loans with floating rates, variable rates, whatever you call it, and from Finland to Portugal, from some of the Baltic countries to Spain, it is the case that some families are hurting because the reimbursements that they have to honor have gone up as a result of the interest rate increases that we had to decide. This is unfortunately not something that we can, alleviate or attenuate, because our task is price stability. Our task is to reduce inflation. And the tools of choice that works in that respect is the interest rates. And we have to use that interest rates. Some countries are taking particular steps and measures, and some financial institutions are also looking at offering moratorium or delay. And I think that the best we can do is to really tame inflation in a timely manner, meaning as fast as we can, in order to then facilitate a return to different interest rates that would not be as high in the future. And I'm not here making any commitment to cut at any point in time. Thank you very much.
Thank you, President Lagarde. And the next question goes to Shogo Akagawa of Nikkei, Japanese newswire, here in the middle.
Thank you. You will travel next week to Japan for G7 meeting. What kind of topics do you want to bring at this upcoming meeting from European point of view? Thank you.
Thank you for giving us that angle from the East. I would hope that together with my European colleagues, we can learn from colleagues, particularly Japan, which has just now, which is moving into a new direction with a new governor. So anything that will be the Japanese monetary policy going forward, and any understanding that we have of their strategy review, which he has announced, will be of interest. And I would be very happy to share with him the learnings from our strategy review, which I had started when I took the job. I would also hope that we can explain to colleagues from Canada, Japan, and the United States that the Europeans together are going to continue to demonstrate resilience, capacity to operate together. And I would hope that in that respect, something that we say in the statement here will resonate, which is to agree on the fiscal governance in short order, so that in addition to having a monetary policy that is common to 20 countries, we also have a fiscal framework which gives governance to the 27 member states, and that fiscal policies that are determined by member states are also focused on value for money, for lack of a better word. In other words, putting in place the right reforms, focusing the spending where it is going to increase the competitiveness and the efficiency of the economy, which is something that is absolutely indispensable in order to have this social contract, which is often associated with Europe. Thank you.
Thank you, Madame Lagarde. And the next question goes to Isabella Bufacchi of Il Sole 24 Ore. Isabella, please.
Good afternoon, and thank you for the opportunity. If I may go back to quantitative tightening, just to understand whether there is more ground to cover on QT, or whether with this end of reinvestments on APP, this is the end of QT. There could be more to be done with PEP, for example, starting on pandemic, or selling bonds to make it even quicker. So this also helps to understand how important is QT as a restrictive tool, monetary policy. And my second question, if I may, is on TLTROs, because even if the European banking system is solid and resilient, and the banking crisis from the US could be over, we hope, still TLTROs are going to end in an odd moment. And are you concerned, or are you confident the banks can give back 500 billion in June and get away with it? 407 about, yeah. Thank you.
Thank you very much. On QT, let me be very clear. QT is the decision that we expect to implement as of the 1st of July concerns APP reinvestment only and nothing else. We have forward guidance on PEP reimbursement, nothing until 24. And you will find, I think, in the annex to my statement, reference to the PEP and to the principle of flexibility, which we believe is an important key aspect of PEP going forward. So those tools are intact. We're not planning on not reinvesting anything that comes for redemption under the PEP agreement. On TLTRO, well, TLTRO, you know, there is no surprise about TLTRO. If anything, we have managed to offer the possibility for banks to accelerate and anticipate the reimbursement, which I think has avoided a cliff effect that we would have had in the, you know, over $1 trillion would have become outstanding in June. Thanks to the accelerated reimbursement, we're now down to 477. I'm checking the numbers because I want to be clear on that. So it's not a surprise. It's a come due date, and reimbursements are due. And I know that banks have prepared for it, and that there is a lot of liquidity out there to continue to prepare. Having said that, you know, it wouldn't surprise me if some of the facilities that we have, that are standing facilities, liquidity windows that are available, full allotment and rates that are well known to all, would become usable. They are usable, but would be used again, because that's perfectly normal job of a central bank to actually provide liquidity. You know, we have weekly, we have the LTRO, 3 months, full allotment on all those liquidity facilities, and if anything was to happen, we have demonstrated in the past that we can be inventive. Thank you.
Thank you very much. This concludes our press conference today. So I wish you all the best. We have the next press conference on 15th of June. And until then, all the best and a good afternoon. Thank you.
A good afternoon to you. Live from New York City, it's good morning from us. Equity futures were negative through most of this morning. We're about 10 minutes into the session now, past the opening bell. We're negative 0.4%. That was won and certainly not done at the ECB in Frankfurt, Germany. It's very clear we are not pausing. We know that we have more ground to cover. This is a journey, and we have not arrived yet. That's the equity market. Let's check out the bond market together. It looks a little something like this over in Europe. The 2-year looking for a move lower by about 7 basis points at 256 on a 10-year, basically unchanged. Their yields a little bit higher by a couple of basis points to 227. To finish in the euro, in the FX market, the euro against the dollar looks a little something like this. We're negative 0.3%. The euro at 110.32. Christine Lagarde, the ECB, this is what she had to say.
It's fair to say that everybody agreed that increasing rate was necessary. That second, we are not pausing. That's very clear. Third, we know that we have more ground to cover on the basis of the baseline that we had and on the basis of the data.
Let's get over to Frankfurt, Germany, and catch up with Maria Tadeo. Maria, that was won and certainly not done from this ECB.
Yes, Jonathan, and if you look at the actual action that was taken today, obviously there was a downshift to 25 basis points. To me, it was very clear, by the way, that a lot of the decision-making here and the thing that may have flipped this decision was that lending survey. Remember, there were so many references that came in throughout the press conference about the data that showed the credit conditions tightened in the first quarter across the euro area. Now, the other point, however, is there was at times, and I'm not sure if we should call it a mismatch, but definitely running on two separate lanes where there is a downshift on the actual policy on the rates. But when you look at the language when it comes to inflation, she continued to say the risks are to the upside. We're not stopping. We're not done yet. Remember, she brought again, this metaphor that she likes to use about the journey. We're on this journey and we've not gotten to that point. Are we restrictive? Yes. Are we sufficiently restricted? No. But I think reading between the lines now going forward is going to be difficult because remember, she repeated, we are focused on the data, but data dependency is not necessarily forward guidance. At the beginning, she refused to really give a timeline. At one point, she mentioned future decisions. That would imply a plural when it comes to more rates to come. But I think it's difficult now to calibrate what may be to come in June and beyond that.
Marita now on the latest in Frankfurt, Germany from the ECB and President Lagarde from the last 60 minutes or so. About 12 minutes into this session, let's get to the equity market here stateside. We're negative 0.5% on the S&P 500. A lot of attention on one name, PacWest. That name is down by 47%. It has bumped into trading halt after trading halt over the last 10 minutes or so. A record low for that name. Reporting by Matthew Monks here at Bloomberg. Over the last 24 hours, the PacWest has been weighing a range of strategic options, including a sale. We've heard back from the company, PacWest itself, responding directly to some of that reporting and saying this, that the company has been approached by several potential partners and investors. Discussions are ongoing. They say the company will continue to evaluate all options to maximize shareholder value. They've also offered some information on deposits as well, which is important to go over, and we can do this a little bit more a little bit later, but I think the top line from them on deposits is that the bank has not experienced any out-of-the-ordinary deposit flows following the sale of First Republic Bank and other news. Again, that name is negative, almost 50%. It is down 48% in today's session so far. Joining us now, I'm pleased to say, is Kroll's Megan Green, a fitting voice for today's programme. Megan, selected to join the Bank of England's Monetary Policy Committee as an external member on a 3-year term. She'll take that seat, joining 8 others on the MPC starting July 5th. The Bank of England Governor, Andrew Bailey, saying this: she brings significant experience from her work across financial services and academia, and we will benefit greatly from her contributions to our policy discussions. And I'm pleased to say we're going to benefit greatly from her contributions to this programme right now. Megan, first of all, congratulations. I understand you're limited from what you can say about the UK and the Bank of England directly, so I'll move away from that. But from all of us, congratulations, and we're looking forward to you taking that seat. I want to start with this. The Federal Reserve, the ECB, from your perspective, Megan, are these monetary policy objectives in conflict with financial stability right now?
Yeah, first of all, thanks for the congratulations, John, from you and also from all of your colleagues over the past couple of weeks. In terms of the separation between macro policy and financial stability policy, I think most central banks like to feel that on paper, at least, they have very specific tools to address each. The reality is, though, when you have financial instability, that impinges on the macro picture. And so there is a gray area where they really overlap. Now, we're not in a full-blown banking crisis now, so I don't think we've gotten to that place yet. But I do think we can be sure that there will be more financial instability going forward as central banks are hiking rates or keeping rates high, and as major central banks are all shrinking their balance sheets. And so, it's not impossible that we will get to that point where these tools really overlap because financial stability impinges on confidence, impinges on credit, lending standards, and so they really become related and intertwined.
Megan, there's this line that we keep hearing from central bankers, sufficiently restrictive, and we've heard that today from the Governing Council of the ECB. Future decisions will ensure that the policy rates will be brought to levels that are sufficiently restrictive. The regional banks in America are screaming, you're more than sufficiently restrictive. How do you judge as a policymaker what is and what is not sufficiently restrictive?
Look, I think if you are only taking a top-down view on an economy these days, you can kind of find data to tell whatever story you want. And so it's really difficult to figure out what the picture is from a top-down perspective. So, I think you can't just look at financial stability in terms of figuring out what's sufficiently restrictive, you also have to look at other aspects of the economy, including bottom-up aspects. In the U.S. in particular, I think the labor market is the real puzzle that we haven't yet cracked. It's been freakishly strong despite so many rate hikes over the past year by the Fed. I think that's a result of labor hoarding, and we don't have a good way to measure labor hoarding or to know when companies are going to capitulate and stop hoarding labor. But I do think that as we go forward, as interest rate policy remains restrictive, as corporate earnings decline, companies will probably have to capitulate and start laying workers off. And we know from academic research that that's when people stop spending. Consumption's about 70% of the U.S. economy, so I think that's when we'll go into recession. So it's not just financial stability. The very interest rate sensitive pieces of the economy are responding to aggressive rate tightening. It's the other parts of the economy, as Christine Lagarde pointed out, the so-called second wave, where it feeds through into the real economy. And there we're not really getting the response that we're used to in terms of incredibly aggressive rate hikes.
I wanted to broaden out the conversation and bring in Alessio De Longis of Invesco into the conversation too. Alessio, 24 hours, 2 central bank decisions, the Federal Reserve having a conversation about pausing. The ECB does not even want to entertain it. We've got to talk about the name that's breaking down in front of our eyes right now. PacWest is down 46%. Alessio, how long before we stop calling this idiosyncratic? I keep asking that question. It's been bank after bank after bank after bank over the last couple of months now. What is this?
I think, John, this reminds us that the lagged effects of monetary policy and how late we are in this cycle always starts manifesting itself. Things break where there are the weak links, right? It was the same way in every prior recession or economic performance leading into that recession. Remember 2006, 2007? The cracks were in the housing market and were in parts of the economy that we didn't even know about. We actually started seeing problems with subprime early in 2007, and at the time we didn't even know exactly what subprime really meant, right? So today we are seeing those weak links struggling, and it's one after the other, and it's just a reminder that monetary policy works with a lag, about 1 to 2 year lag. We started raising rates only a year ago, so in my mind, this is just the beginning of that slowdown. And as Megan said, interest rate sensitive sectors are behaving according to what we would have expected. Housing and manufacturing have already started that downturn. It's in services that we don't see that interest rate effect. Megan illustrated that earlier. PMI employment surveys are actually rising. So that's where the disconnect is. I think this is not idiosyncratic. This is the beginning of that slowdown induced by monetary policy.
Megan, do you see this as a feature and not a bug in monetary policy?
The fact that it's not feeding through into the real economy, I think we're in a really weird time in history where we shut down the economy and then thought it out, and all kinds of things are behaving differently from how they should. So, it's inevitable that monetary policy feeds through with a lag, but I think this time around it's just even harder to figure out how long that lag might be and exactly how monetary policy will feed through. Because we've been through so much over the past 2 years.
What do you think the optimal approach is? I mean, we've been talking about this for a while, whether a policymaker should be ex ante or ex post. What do you think the right approach to the incoming information is?
So I think policymakers are doing the right thing in getting rid of forward guidance and deciding that actually they really do need to look at the data without concentrating so much on every single month's data point. I mean, look at the Fed, for example. Inflation's been coming down. Peak inflation hit towards the end of last year, but it was always going to be a bumpy ride. And so being data dependent without being overreactive to every single data point, I think is the only way to go here.
Do you take the view that perhaps we need to appreciate some of the secular components to this inflation story a little bit more with that in mind? Mohammed Al-Erin's talked about that a million times on this program. We need to take a more strategic view of the direction of travel here.
Look, central banks have to look at a medium-term perspective on inflation. That's a couple of years. And so you do have to consider some of the secular factors, but quite a few of the secular factors will be even bigger impacts over the long term. And the secular factors actually tell you a bit of a mixed story as well. We're going to spend a lot on the green transition. We're going to spend a lot on defense. That should whittle down the international glut of savings that we've got. And so that should, on the margin, put some upward pressure on inflation. But offsetting that, you have a huge amount of automation, digitalization, that should work in the other direction and should reduce pressure on inflation. As I said, on the margin, I think the structural picture suggests that inflation should be a bit higher than it was before. Does that mean we'll have 4 or 5% inflation? Absolutely not. I think it could be a little bit higher, around 3%, but that's going to kick in over a number of years. And so in terms of trying to figure out a 3-year forecast, it's not clear that the implications will really hit over the next 3 years.
Let's just get to some of these moves that we're seeing in early trading about 22 minutes into the session. The single names at the bank level, PacWest down 45% intraday, Western Alliance down another 24% intraday. These are some major moves. I wanted to go through some of the deposit numbers. PacWest says insured deposits total 75%. Compare that to SVB, where more than 90% of its total deposits were uninsured. It's clear that there is a very different deposit profile to this institution. And yet here we are, Alessio, with PacWest getting absolutely slammed by 44%. Do you think we're focused on the right thing? Alessio, when you see a move like this one, what is it about from your perspective?
In my perspective, it's really about a reminder that contagion in sentiment, that bank run that you may not see today through an image on television of people lining out to the ATM, but rather you see in this type of performance in the equity, in the financials. It's a reminder that at a certain point there is an element of confidence that is just evaporated, and that's what banking system is all about. Is about that ability and willingness to repay and engage with each other, right? So I think it's a reminder that it's not a time to be, from a portfolio perspective, it's not a time to be in cyclicals. It's not a time to be in financials, and it's not a time to be in other sectors that are screening with that value bias and are dependent on that cyclicality in the economy. It's about being defensive and playing much closer to your benchmark risk profile.
We're working through a monster rate shock as the Fed has gone from 0 to 5 in a little more than 12 months. Megan, is there a risk here that this rate shock, the focus starts to shift away from that and it morphs into something more focused around credit? Are you starting to see that evolve slowly in the last week, the last couple of weeks?
Yeah, you're starting to see spreads widen out a little bit in credit markets, but I don't think we're actually there yet. What really worries me about what's happening in terms of financial instability is that, particularly with First Republic, the result that we found a solution. It wasn't the best one, though, and there doesn't seem to be a whole lot of soul-searching about how we might do better next time, and I think it's a result of misaligned incentives among the government, larger banks who might take over, be purchasers of these smaller banks, and the smaller banks. So there's no easy fix, but I think we can be sure we'll see more of this. We're already seeing more of it with PacWest. I'm trying to come up with a better option where we don't wait a month and a half to find a buyer, which just means that there's more time for equity prices to crash, contagion to set in, which should be our biggest concern. I think that should be the focus right now.
Alessio, final word from you, please.
It's a reminder that the economic slowdown is happening. I think today's ECB meeting reminds us that there is an interesting divergence going on. From a portfolio perspective, my inclination here would be to have a more defensive portfolio in the U.S., more duration in the U.S. rather than in the Eurozone. I think their fixed income markets has some way to go in terms of pricing in the extent of future rate hikes. And there is an interesting opportunity here for divergence in favor of the euro versus the dollar.
Alessio, thank you, sir. Good to hear from you, as always. Alessio, the longest there. With the brilliant Megan Green. And Megan, once again, from all of us, congratulations. I look forward to catching up with you soon. Thank you. Looking at the broader market right now on the S&P 500, 25 minutes into the session, we are negative 0.5%. That's not a major move, considering what we're seeing develop right now in PacWest, trading halted once again. As I can see it on my screen, we're negative 42% on that stock. Let's get to the trading diary. A little bit later on this afternoon, Apple earnings after the closing bell. US payrolls coming up tomorrow, plus Fed speak from Bullard and Cook. We get US CPI next Wednesday, believe it or not. That's just around the corner. PPI and another round of jobless claims to round out the week. On Thursday, coming up tomorrow, our payrolls coverage with BlackRock's Rick Reeder, iCapital's Anastasia Amoroso, PGIM's Mike Collins. They all join us this Payrolls Friday. Looking forward to that conversation with your equity market. Negative by 0.5%, and the attention of the world now on one banking name again, except it's got a different name. This time it's PacWest. We're negative 42%. From New York, good luck for the rest of the trading day. Thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
big ideas. We show the productivity increases that are possible because of artificial intelligence. It's these companies who could be some of the biggest beneficiaries if they harness AI correctly. I think a lot of people are looking for the killer app, like they look like these viral apps that the internet delivered. The killer app for artificial intelligence is productivity gains, and any company does not harness it is probably not going to be one of the big winners out there. And just one other thing on AI. The real winners here are going to be those companies that have proprietary data and have lots of it, have the best domain expertise, best AI expertise, the best pools of high quality data to basically create new businesses.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
From New York City,
from London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this
Story.
story.
Is there the kind of upside?
Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi-Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, Pepsi goons bomb their own trucks. And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the number fever campaign. Del Fierro thought Pepsi's number fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees. But for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue a warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning 1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as the coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3